The US equity market has done so incredibly well. It's been an incredibly strong performing market.
I do still think that corporate earnings are actually still doing quite well.
At the end of the day, valuation does tend to matter. I don't think valuation is dead.
We think that valuation discipline probably is the most important thing to have at this time.
Focus is so much on the Mega 7 and following the trend there that a lot of these different pockets of the markets are beginning to see some fundamental momentum.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday on a two-day losing streak on the S&P 500 for the first time since early September. Equity futures this morning, negative by 0.2% on the S&P. On the Nasdaq 100, we're down almost a third. On the earnings calendar today, AT&T, IBM, Boeing, Coca-Cola and Tesla in focus this morning. Big disappointment over at Starbucks. Suspending 2025 guidance. Numbers down 10% in the US, down 14% in China. That stock is lower, Lisa, by 5%.
And this is basically coming after a slew of bad news for Starbucks, new leadership, and a question here as they strip out and say they are going to suspend any guidance for the full year. Is this just cleaning the slate, or does this indicate something more material at a time where they basically say they need to fundamentally change the business model, with baristas complaining about not necessarily having enough staff, with too many products, and really a question about some of the boycotts and other issues globally?
When you look at the research, it looks like potentially there's going to be more tough quarters ahead for Starbucks. Edward Jones, there's going to be some tough quarters moving forward. At Jefferies, tough road ahead and reaccelerating what's going on with the traffic worldwide. Morgan Stanley, remarkably poor. What was so interesting, I found, is that transactions in the United States down 10%. That is the steepest from the depths of the COVID-19 pandemic, when no one was out and about getting Starbucks coffees. They were home, isolating.
If you've got a foot in the US and a foot in China right now, you need that foot in the US to perform. And that's not happening. In China, the numbers were dreadful. This is what L'Oreal had to say on China, because it's not just Starbucks. In mainland China, the beauty market, already negative in the second quarter, continued to deteriorate. LVMH, just last week, you will remember this line. Consumer confidence in mainland China today is back in line with the all-time low reached during the pandemic, COVID. As you say, things are not great over in China.
Carrying reports after the bell today, a real question here about how much you see that continuation in luxury goods, which is the reason why it's so interesting that Apple was sort of a distinction. We talked about that earlier this week. Tim Cook over in China for the second time this year, talking about its commitment to the area. How much do executives basically have to go kiss the ring in order to get some sort of money into their coffers? Or is this an issue of just the product mix and where consumers in China are buying or not?
We've got to talk about McDonald's as well. In the pre-market, negative by more than 7%. News late yesterday afternoon. An E. coli outbreak linked to Quarter Pounders over at McDonald's.
And this is particularly in a number of regions that are in the center of the nation as well as out west. And a question of whether it's linked to the onions with one supplier. I know this is really ridiculously specific, but that's the level of specificity. It's just an unfortunate blow for a company at a time when ultimately there are some real questions on a consumer level, how much appetite people have, how price sensitive people are, how much of a liability is it to have to take your Quarter Pounders off and start worrying about onions.
It's not good at all, let's put it that way. We're down about 7% in the pre-market. More on that story a little bit later on this morning. More broadly, equity futures near session lows. We're down 0.25% on the S&P 500. In the bond market, the grind higher continues. Bramo yields up 2 basis points, 422.
And these are the highest levels that we're seeing on 10-year yields going back to July 25th. I have to wonder how much we're seeing the sort of derotation in equities. We were talking about the rotation into cyclicals, into small caps, and that all came with this beautiful decline in yields. And everyone was saying disinflation's amazing. The Fed's going to cut rates. Inflation's going to come down. That's been challenged. And how much is that challenging the entire narrative of a market with yields that are now at the highest levels in more than 2 months, at the same time that you're seeing a sort of rotation back into the big stocks? And that's sort of one of the questions. Is that sort of a blip or the new trend?
So we've had a big debate around the table about whether this is the economic data or whether it's the politics. And we noted yesterday that the move was global. We saw this play out in Europe, in Australia, not just the United States. There's a bit of divergence emerging this morning between Germany and Europe. At the front end of the curve, on a German curve, the 2 years down 7 basis points this morning. Now, I know it's only one day, but when it comes to the election and the policies that we could see from a Trump presidency, wouldn't you assume that would lead to a disinflationary shock in Europe and lead to lower interest rates, and the prospect of leading to higher interest rates, or maybe at this level in the US, an inflationary shock, and we'd see further divergence. It's one day, but it's something I think we've all got to keep on our radar.
Especially because we talk about China, where are they going to sell their products into Europe? It just raises this question, though. We've been exploring this, and I was thinking about this overnight. How much can you see a divergence between the U.S. and European bond markets, even if they do get disinflation, even if they have deflation, even if the ECB is cutting rates? How much is the global bond market linked? Because otherwise, why do you explain yields going higher in certain regions when the economic data is stronger in the U.S., not Europe, when the inflation data is stickier in the U.S., not Europe? So these are some of the questions you have to wonder about the connections, interconnectivity of the bond market globally.
The 2-year in America up a single basis point, just north of 4%. Coming up this hour, we'll catch up with Ben Gutteridge of Invesco, seeing a positive mix for equities. We'll speak to Seth Goldstein of Morningstar ahead of earnings from Tesla, and Jordan Rochester of Mizuho on the so-called easiest job in Washington. We begin this hour with stocks on a 2-day losing streak for the first time since early September, as elevated bond yields and the prospect of a slower pace of Fed rate cuts continues to weigh on sentiment. Ben Gutteridge of Invesco remaining bullish on equities, writing, "We're seeing resilient growth, moderating inflation and more accommodative monetary policy. Despite challenges, this is generally a supportive mix for equities." Ben joins us now. Ben, let's talk about one of those challenges, the election. How do you expect us to trade over the next few weeks into that one?
Well, look, I mean, there are multiple outcomes, both of different colour and different mix. And one would expect the market can so easily have a tantrum to one outcome, could so easily fly on another. But we would say over the fullness of time, markets tend to sort of fade extreme reactions. I would say such is the dynamism of the US economy and quality of management and innovation within businesses that despite hedge funds, whacking on and taking off trades, from one day to the next in and around the event, stock markets can get through this in a positive, would get through this in a positive fashion.
Ben, how much of a constraint is the bond market right now with 10s back up to 422 and a 2-year with a 4 handle?
It's not a constraint just yet. I think whilst the Fed and the market still believes we're in a cutting cycle and that growth can remain resilient to that, alongside that, then markets can continue to perform. I think quite as expected. Markets will sort of check themselves and showcase volatility as the pace of cuts slows, and there are some question marks about whether hikes come back to the table. But the trend remains a disinflationary one and therefore supports a cutting cycle. And therefore, I think markets can deal with yields at this level.
Let's define markets, Ben, when we talk about markets being able to deal with rates where they are, even as they climb a bit. And I say this because we have seen a challenge to the rotation trade. We've seen a challenge to this idea that small caps and the rest of the 493 in the S&P can perform and outperform. We've seen a challenge to that as yields go higher. Do you think that sticks?
Yeah, I mean, it looks to us as though there isn't sort of an imminent catalyst for a yield reversion. Of course, growth looks better, so a reappraisal of how dovish the Federal Reserve might be. Certainly a focus on supply of bonds, given the sort of political agenda really of both parties, and better growth. So, it does look as though yields will be are well supported at this level. That supports, we would say, higher quality. The funding challenges that higher yields bring suggest that higher quality businesses might continue to sort of shine in this environment. But I think ultimately we return to a disinflation narrative, and that the sort of softer landing, resilient growth becomes the focus once again. So in time, I think there is a sort of a catch-up trade from the sort of small mid-caps, but perhaps that's not the immediate position to take today, given there is some nervousness about this sort of higher yield environment.
Ben, we're talking about the higher yield environment in the U.S., but as John was mentioning, it's global. And we've seen yields really tick up around the world, even when the data might not be as obviously supportive as in the U.S. How much is the U.S. setting the tone and the rest of the world gets subjected to it, and that's it?
Well, I mean, I think I think that is the case. I mean, I'm sure it's not quite such a surprise for everyone that is the case. I mean, it's interesting at this moment. I think, as you sort of said, is that Europe's going through quite an appreciable sort of growth wobble at the moment. Certainly some, the manufacturing weakness weighing heavy on the European economy, and yet bond yields moving higher, sort of dragged higher by what's happening in the US. But, such is the dominance of the US economy, and such support, avoidance of recession in the US offers the global economy that is sort of dominating at the margin on bond yields. But for sure, the growth challenges look a little more precarious in Europe, and therefore the opportunity for duration, for buying bonds, and the opportunity in yields looks a little bit more apparent at this moment in Europe.
One place in Europe, though, you do like is the United Kingdom. Why do you view that as a hedge?
Well, I don't know if you've heard the argument before, but valuation looks interesting. You tend to get a bit of eye rolling at that because it's been sort of trotted out, I don't know, for the last 15 years or something. But valuations certainly look interesting relative to some global comparators. Certainly dividends are always interesting. But I think relative to some very downbeat expectations, growth could impress. But look, the hedge reflects, sort of commodity-rich components of the UK market, and thinking about a geopolitical hedge in amongst the valuation hedge makes it a reasonable portfolio complement to a more substantial position in US equities that we harbour.
Hey, Ben, it's good to hear from you. Ben Gutteridge there of Invesco on the latest. I wasn't rolling my eyes. I remember when I first moved here and there was a guest, and I think they said this on air. They said to me that Europe was good for vacations and not for investing. And I was personally offended. Then after about a year, I realised that they were probably right. That Europe was only good for vacations and not investing based on the returns we've seen in America compared to Europe over the last decade.
I mean, even last night, when you looked at all the earnings that were coming out from the European region, in the U.S., beat. Things are looking okay. Even those that disappoint, we're able to raise prices. It's going to be fine. In Europe, some big questions. I don't know about China, whether the consumer were uncertain, and stocks going to the tanker. So this is sort of this highlighting the differential between the two regions.
You tell me which sector is going to perform, and I'll tell you which index will do well. 1% of the FTSE is tech. 1%. It's like nothing.
Okay, there is an argument, and this is actually the bull case in the UK. You're welcome. I think that there is this argument that there is the old industry, the dinosaurs, the clunkers, and the whole idea... Jurassic Park, right? That's your comment. And I just wonder how much you start to see this revival in the idea of the industrialization, the reindustrialization of the world. And if that's the case, then maybe there can be some real outperformance.
That's Ben's argument. We'll see if he's right. Equity futures right now on the S&P 500 down about 0.2%, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of McDonald's down 7% in the pre-market trade. The CDC said that a severe E. coli outbreak linked to McDonald's Quarter Pounders has killed one person and sickened dozens. Most of the cases are in Colorado and Nebraska. McDonald's has identified onions as being the likely source of the outbreak and removed the Quarter Pounder from its restaurants. Starbucks also down decisively 5% in the pre-market trade. The coffee chain reported its steepest quarterly sales drop in 4 years. It pulled its guidance for 2025. Starbucks said withdrawing guidance for the current fiscal year will give the new CEO, Brian Niccol, an opportunity to solidify a turnaround plan. The LA Lakers made basketball history last night when LeBron James and his son Bronny became the first father-son duo to play in the NBA together. The 39-year-old superstar and his 20-year-old son played for almost 2.5 minutes together late in the first half of Bronny's NBA debut. The elder James finished the night with 16 points while his son was held scoreless, recording 1 rebound. The Lakers beat the Minnesota Timberwolves 110-103 to tip off their season. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Jamie Dimon's next move.
A lot of things we've done which I think are bad, whether you're Democrat or Republican, we support, it's often done in the name of good, have hurt the lower 20%. I reserve the right to do whatever I want. Okay, I'm a citizen, I can vote, I can say what I want.
The latest reporting on that, up next from New York. Good morning. 2 days of losses could become 3 on the S&P. Futures negative by 0.2%. Bond yields just a little bit higher, up a single basis point. The 10-year 421.97. Under surveillance this morning, Jamie Dimon's next move.
A lot of things we've done which I think are bad, whether you're Democrat or Republican, we support, they're often done in the name of good, have hurt the lower 20%. I think we have to be very clear-headed about how we can accomplish what we want to accomplish to lift up all of America. I reserve the right to do whatever I want. Okay, I'm a citizen, I can vote, I can say what I want, and stuff like that. I've never been in the practice of endorsing candidates, and so, but I'm thinking through what I want to say or do or something like that.
So here's the latest. Jamie Dimon reportedly telling associates he supports Vice President Kamala Harris, but fearful of blowback, he's holding back from saying it publicly. The New York Times writing, Mr. Dimon has made clear that he supports Vice President Kamala Harris and would consider a role, perhaps Treasury Secretary, in her administration. Joining us now is Bloomberg's Katie Lyons. Katie, that's New York Times reporting. What is reporting elsewhere telling us about this move?
Well, there's been a little bit of pushback from Forbes, John, that is reporting that Jamie Dimon is not considering being part of either a Kamala Harris or Trump administration, whichever one we end up with. So pushing back a bit on that suggestion in the New York Times that he would be open to serving as Kamala Harris's Treasury Secretary. All that said, when we look at the Times reporting, it is noteworthy that Jamie Dimon is a registered Democrat. And again, the Times is saying he's just not being vocal and public about his support for Harris over fear of retaliation. And that was what was really dominating conversation around this here in Washington, was that was the premise on which Jamie Dimon is choosing to keep silent here over concern about potential retaliation, not just against him, but the public company that he leads and potentially shareholders by extension, as Donald Trump has not necessarily made secret his feelings about retribution. Now, we were just hearing there the Jamie Dimon interview that Lisa conducted earlier this month, in which he talked about not just his withholding at this point of an endorsement, which he is still mulling over and again has not made publicly, but also some of the ideas of what he would like to see out of a future administration, including potentially represented on the cabinet someone from the private sector or perhaps even someone from the opposing party of whoever the president is. And on that note, we have seen Kamala Harris kind of supportive of that idea. She has said on multiple occasions she would appoint a Republican to her cabinet. And certainly she has been campaigning with a number of Republicans in these last few weeks here of the race as she tries to court those voters. So it's possible that Jamie Dimon likes what he sees on that front. But again, this is not a public endorsement that he is making.
Kayleigh, individuals I spoke to said the Harris campaign does not forget the comments he made about former President Donald Trump in Davos. But just taking that aside, could you see any Wall Street CEO being the Treasury Secretary under a Democratic administration?
I mean, it's certainly possible, Anne-Marie, though it's hard to identify if it's not Jamie Dimon who that person would be, and especially considering there are other candidates in the running. There's been a lot of conversations I've had recently about Wally Adeyemo, obviously currently Deputy Secretary, someone who is very young but potentially could be elevated to the role of Treasury Secretary, and a number of others who would be considered here. When you're considering the Democratic Party as a whole and the kind of pushback that might come from the left, from people who are more skeptical of Wall Street, some of the very constituents that Harris would need, the coalition she would need to elect her president, there certainly could be some blowback there. But I think a lot of people would tell you when we're considering cabinet conversations with less than 2 weeks to go until Election Day, that's not where the primary focus is at this time, is they're just trying to turn people out at this point.
And, of course, also trying to make sure they still get the fundraising. That game is still entirely in play. And that brings us to this next story coming out of the New York Times as well, saying that after decades of sitting on the sidelines of politics, Bill Gates, one of the richest people in the world, has said privately as well that he recently donated about $50 million to a nonprofit organization that is supporting the VP Harris. How significant is this, given the individual Bill Gates has notably been very quiet for decades on his political standings?
Yeah, and this was supposed to be quiet too, Anne-Marie. The donation he made, according to the Times reporting, was to the nonprofit arm of Future Forward, which is one of the main outside groups supporting Harris. That is a dark money organization that does not have to disclose its donors. So this was not necessarily supposed to come to light. And Bill Gates, in a statement to the Times, didn't confirm this donation or outright endorse Harris, just saying that he views this election as, quote, different, with unprecedented significance for Americans and the most vulnerable people around the world. So obviously, obviously, this is a sizable donation, and it is worth pointing out we are seeing some of the richest people in the world having an outsized role in the money race in this campaign, including on the other side, where Elon Musk has donated $75 million to America PAC, an organization that is supporting Trump and is now giving out $1 million to a registered voter through a sweepstakes if they support a petition to support the right to free speech and to bear arms. So money certainly is still playing a role at this stage in the game. Where it goes, though, is really what is starting to shift. It's not just about paying for advertisements right now, but it is about actually being able to invest in the ground game and people to go knocking on doors. Donald Trump has largely been outsourcing his ground game, not necessarily the case with Kamala Harris, that has raised more than $1 billion since she launched her candidacy this summer. They have 2,500 staff across 350 offices throughout the country, going out, knocking on doors, doing that ground game, trying to turn people out to vote. And in a race with margins this tight, the ability to contribute money in that way toward the turnout game is what ultimately could make the difference.
Kayleigh, forgive me, I do kind of want to focus on policy, and I want to link these two stories together. We talk about how we don't know who the cabinet is going to be if Kamala Harris were to win. We have some sense of Donald Trump's because there are a number of people that we've talked about who are potentially being considered as Treasury Secretary. We've talked about some of the transition committee led by Howard Lutnick. Do we have a sense of who the characters could be who might be Kamala Harris's right-hand people?
Well, there are people that are close to her. In many ways, there may be similar faces to what we've seen in this Biden administration that she, of course, has been a key part of over the course of the last 3.5 years. I mentioned Wally Adeyemo. There are others who have been in the mix as well, including Lael Brainerd, who, of course, is currently at the National Economic Council. And there's some question as to how much continuity there would be with the well-known in Washington to this administration moving forward into a potential Kamala Harris administration, as she has tried to articulate, especially in recent interviews, the idea that her presidency would not be a continuation of Joe Biden's, although she hasn't necessarily clearly defined how those differences would really manifest themselves, just that she would have new ideas, and potentially that would mean new faces as well. But we really haven't seen it come into focus to the same extent we have seen on the part of Donald Trump. Many of the surrogates that are out there for him, people who ran against him even in the primary cycle, have been very vocal in their support of him, making the rounds, doing the circuit, if you will, including people who could potentially be Treasury Secretary. You mentioned Howard Lutnick, but of course there's also Scott Bessent to consider here, as well as many other names, including members of the Senate, like Senator Bill Hagerty of Tennessee, who I've heard for both Treasury and state. There's just more people who have already, or who are still potentially serving roles in government on the Trump side, compared to Kamala Harris, who is leaning heavily on people who've already exited their government roles, like, say, former President Barack Obama, who has been on the campaign trail for her in recent days, will be joining her, as well as his wife, Michelle Obama, in the days ahead as they hit more swing states.
Kayleigh, got to squeeze one more in. The big one, Joe Rogan. Is that official now?
According to Politico, that podcast recording is happening on Friday, John. Donald Trump had said he would be sitting down with Joe Rogan. So that is our understanding, is that interview will happen on Friday. Both of these candidates really hitting the podcast circuit here in the final weeks of the race.
That's a big one, the biggest one.
Yeah.
Kayleigh, down in Washington, D.C. Kelly, appreciate it. Thank you. Kelly Lyons there. You can catch up with Kelly, of course, on weekdays at 12 and 5 p.m. Eastern on Balance of Power. That's the one the Trump campaign has wanted for quite a while.
Yes, and also there is some beef between Joe Rogan and the former president. Potentially it's been squashed now because Joe Rogan came out and was very supportive of RFK Jr. That's going to be very interesting. This is Trump, though, just shoring up his base. It's basically like Kamala Harris going on Call Her Daddy. The more interesting interview will be if Kamala Harris decides to sit down with Joe Rogan.
We'll see if he makes the offer at the start of that conversation a little bit later this week. Up next on the programme, Tesla results are just around the corner. We'll speak to Seth Goldstein of Morningstar in just a moment. From New York City, with equity futures on the S&P 500 just a little bit softer, we're down by 0.2%, and bond yields just a little bit higher, up a single basis point on a 10-year 4.22. From New York, this is Bloomberg. The stock market rally stalling to start the week. Down a little bit on Monday, same again on Tuesday. This morning, negative by 0.2% on the S&P. The first back-to-back losses on the benchmark in America since early September. It's been a while. On the Nasdaq, softer this morning, but on the Nasdaq 100, 5 days of gains. So tech is holding up in the face of high yields. So let's talk about higher bond yields. Once again this morning, making a bit of a move in a bond market on a 10-year, up a single basis point, 421.77. On twos, Lisa, up 1 to 4.04%.
You put these ideas together, you've seen a real outperformance from big tech, you've seen an underperformance from everything else, in particular from the Russell 2000. You have to wonder, the more that yields climb, the more that some of these more yield-sensitive areas start to retrace some of the gains. You have to wonder also how far it can go. Is this a bet on higher inflation? Is this a just hedge against the election at a time where implied volatility in bonds is the highest so far this year?
Bring up the charts and look at where the 10-year was on September 18th. We've talked about this a few times through the week. September 18th, the Fed reduces interest rates by 50 basis points. The 10-year's adjusted higher by 50 basis points since then. Check out the FX market. Dollar yen, the low of the year on dollar yen, 140. 2 days before the Federal Reserve cut interest rates by 50 basis points. And here we are at 152.63 and up another 1%. Remember the call for a weaker dollar? The Japanese yen was going to make a comeback. Here we are, back in the 150s.
This came after Japanese policymakers came out with proclamations. Maybe they don't need to hike rates so quickly. You had some data that actually disappointed, gave them some leeway. And then now there's sort of this question, will they, won't they? Bond yields. Did you see that 40-year yield over in Japan, the highest level going back to 2008? Just a real question mark about how much they've really tamed or not some of the losses that they previously had.
And some real divergence elsewhere as well. If you just look at euro dollar this morning, the euro with a 107 handle, 107.81. We're down 0.2%. We've talked a lot about the growth differentials. Rate differentials kicking in as well this morning. The German 2-year down by 7 basis points, just north of 2%, at the same time that the US 2-year is up a single basis point. So that spread gets a bit wider.
I just wonder how much we can widen out, right? I mean, this is really one of the key questions at a time where traditionally the bond market has been global. Unless you get a real change in the dynamic of the fixed income, of the FX transmission mechanism, you have to wonder whether basically U.S. yields are going to rise because there's strength and European yields won't go down as much as they otherwise should to stimulate that economy because it is a global bond market. It's sort of the issue that they've got to deal with.
That's the cross-asset picture this morning. Plenty of single names as well to talk about. Under surveillance this morning, Starbucks delivering disappointing earnings, pulling guidance for 2025 after sales plunged for a third consecutive quarter. The coffee chain reporting a 7% decline in same-store sales, with weakness especially evident in both the United States and in China. Lisa, Starbucks down almost 5%.
Yeah, 10% declines in the U.S., something like 16% over in China at the same time that they're dealing with a real existential question. What is their business model? How many baristas are they going to have in each store? What's the product mix like? Can they continue charging $7 for a pumpkin spice latte? I mean, these are some of the key questions as they try to figure out what's the price point. I know that parents might be trying to restrain their children from deploying overly aggressive cash hauls over at Starbucks. But, you know, a real question for the new CEO.
And overly aggressive caffeine for those children, not just the cash haul and getting that caffeine.
Don't even.
But the interesting point here, and Jonathan, you brought this up earlier, is they're being hit on both sides. If you cannot make up the growth in China, which is down 14% according to the latest earnings report, then you need to be growing. You need to have that traffic continuing in the United States. And what hit me is this is the worst quarter going back to the depths of the pandemic. So that seems like, is this the bottom for Starbucks, or potentially is there more room to fall for them when it comes to that traffic?
The new CEO has got a massive job in front of them. That stock is down by more than 4%. Elsewhere, Texas Instruments saying the timing is right for a recovery in orders following 8 straight quarters of revenue declines, adding that 3 of its main markets have begun to rebound, but its biggest sales sources, industrial and automotive chips, are still suffering from excess inventory. So off the back of that guidance, the stock climbs by 3.5%. But I want to go back to something that Lisa pointed out in the last few weeks on this program. The difference between supplying the AI story and supplying everything else. AI is fine. Everything else, not great at all.
But this doesn't really make sense after a while, because you have to imagine for AI to continue being its sort of behemoth self, it has to trickle over into autos. It has to trickle over into the industrial sector. There has to be an application aspect of it that goes beyond cloud. And that's sort of the gap that needs to get bridged that we're not seeing just yet.
What I found interesting is on the conference call, management is saying that the strength actually came from the Chinese electrical vehicle market. Why? China keeps producing them. They keep producing them with subsidies and dumping on other markets. But weakness in the auto sector outside of China is where it is very weak. So they're still able to sell into China, and China's doing well in that EV market. But everywhere else, it's going downhill.
One more name for you, getting tons of attention over the last 12 hours or so, McDonald's. Quarter pounders linked to a severe E. coli outbreak. That stock is down by more than 7%. Dozens of people in the US falling ill, mostly in Colorado and Nebraska, and one person dying. The company saying slivered onions with a likely culprit, and it's removing the hamburgers from restaurants in the affected areas.
So it looks like these onions are, as you say, the culprit. They're removing them from the quarter pounders. Very sad what's going on with this severe E. coli outbreak. CDC coming out with that yesterday. Now they say 10 people have been hospitalized, including a child. Obviously, this is incredibly sad given the fact that, you know, there are McDonald's all over the United States and people go there. I will say, though, McDonald's has been under a ton of other political pressure as well, with Democratic senators in Washington, D.C. saying they're price gouging and they have too many high menu items.
Corporate profits must not come at the expense of people's ability to put food on the table. Not a great 24 hours for McDonald's.
No, I think that actually the E. coli thing is more serious than the proclamations
Far
from
more
DC.
serious.
I mean, not just when it comes to people's health, but also when it comes to reputational damage. We saw that with Chipotle for years after 2015, and there's a real question of how they're going to respond to this.
Just want to turn to the latest earnings as well from AT&T this morning. Just getting some results from them. EPS coming in at 60 cents, the estimate 57. Free cash flow 5.18 billion, the estimate 4.69. Lisa, I know you're going through these lines as well. What jumps out for you?
Well, revenue came in down almost 1% year over year, 0.7% year over year. But really, this is a beat. What I find interesting is it was a beat led by, guess what, the U.S. So we're going to go through the numbers and see what's going on. They continued and reaffirmed their expectations for the full year. You do see their shares lower as they do underperform in certain areas. But again, I'm sorry, you have to think about all of the misses in Europe and all the beats in the U.S., and you start seeing those headlines and you start feeling a theme.
I'm not sure this was an opportunity to take another dig at Europe, but here we are, another dig at Europe. AT&T is down by about 3.7% in the pre-market. I'm not getting defensive. Tesla, preparing to report third-quarter earnings after the closing bell. Investors looking for details about the Cybercab unveiled earlier this month and any updates on a potential cheaper car in the works. Seth Goldstein and Morningstar writing, during the second-quarter earnings call, management maintained its timeline for a new, more affordable vehicle to enter production next year. This vehicle will likely drive double-digit delivery growth in 2026 if production begins in 2025. Seth joins us now for more. Seth, welcome to the program. Do you expect any details on that a little bit later?
Well, I'm hoping we at least get an updated timeline. Last quarter, Elon Musk said we don't do product reveals during earnings calls. Those are separate events. So we might not get details like price or range or other auto specs, but I'm hoping we at least hear production is going to be maintained, or if not, there's a new timeline for the vehicle to enter production.
I've got a bias, Seth. The first thing I'll be looking for is how things are in China, given how much China's been in the news over the past few weeks. We've had mixed warnings on China. L'Oreal, LVMH, Starbucks overnight saying things aren't great. Then we had reports that things are okay with Apple's iPhone. What's your read on Tesla in China, in what I consider to be the most competitive auto market on the planet?
It definitely is the most competitive auto market on the planet. We have seen Tesla. There are reports from the CAAM saying that Tesla did see deliveries growth in China in the last couple months of the quarter. So I expect China will be stabilizing and slightly improving for Tesla as we see consumers demand more new energy vehicle sales, where EVs and plug-in hybrids are now more than 50% of all new autos sold for the past 2 months in China. So this benefits Tesla and their other EV peers. And I think China is, not as bad as it was, say, a year ago or earlier this year. Is stabilizing or even improving for Tesla.
Seth, we were talking before for months about how Tesla is not a car company. It's ultimately an independent automotive company that can actually drive your car and have a robot that serves you dinner. And then there's some questions after the We Robot incident and some of the lack of progress or lack of clarity as far as when you start getting that autonomous vehicle kind of capability. How important is that in this earnings report?
I think we need to see more data points on the FSD software, something like user adoption rate. Certainly, I want to see if miles driven by the FSD software is growing exponentially, which is what management needs to see. Because remember, to get to a robotaxi from the current supervised full self-driving software, first there needs to be the wide launch of the unsupervised software for current Tesla drivers, and then it keeps improving there to be able to enable the robotaxi, the cybercab, and the cybervan to be deployed and be deployed safely in a manner that doesn't get them quickly undeployed from the roads due to an accident. So the first step is the initial launch of the unsupervised full self-driving next year in Texas and California. And to do that, to get there, we're going to need to see the FSD software continue to be trained and see exponential miles driven growth in this Q3 report. So I'm hoping we get that data again this quarter.
How crucial is that for you to maintain your equal weight or maintain basically your fairly valued assessment of its shares?
Well, I don't have much weight as far as the robotaxi business in my valuation, but what I do think is a differentiator for Tesla to grow deliveries, and I'm forecasting deliveries growth to a little under 5 million vehicles by 2030. And a differentiator for Tesla to get there is going to be the full self-driving software. And even if that's just a level 3 software that allows for current Tesla owners to have a much better and easier driving experience, that's still going to be a differentiator, which means the software needs to improve from where it is today.
When you think about Tesla and how much they're exposed to China when it comes to the batteries, you know, we have the market pricing in this potentially Trump either win at the White House or actual red wave. What does that mean for a company like Tesla with walls going up when it comes to China and also maybe the idea of the Inflation Reduction Act being pulled back and less subsidies for electric vehicles inside the United States?
Tesla's well positioned with manufacturing bases in the U.S., Europe, and China, so that somewhat insulates them from any potential tariffs or trade wars or protectionist policies. And I do think that even if the Inflation Reduction Act were to be pulled and Tesla no longer gets a $7,500 subsidy, what we're likely to see is a near-term dip in EV sales. But longer term, I point to the new, more affordable vehicles set to hit the road from the likes of Tesla, Ford, GM, and Hyundai, and Volkswagen, and the infrastructure bill from 2021 funding the build out of high-powered EV chargers along highways and in cities as the long-term catalyst for EV sales growth in the U.S. So longer term, I really see no impact no matter who wins the presidency. But should Trump win and reverse the Inflation Reduction Act, there could be a near-term hit to EV sales in the U.S.
Does it concern you that the C-suite of Tesla is so close to the politics currently?
Well, what I look for if I were to be concerned is this affecting Tesla's sales in the U.S.? Are voters who are Democrats being turned away from Tesla because of Elon Musk's closer relationship with Donald Trump? And so far, the data hasn't shown that. We've seen the Model Y grow, Cybertruck sales grow, Models S and X grow. Where we have seen the decline is in the lower priced Model 3s, but that's consistent with vehicles in that price category, which tells me that higher interest rates and are the major driver making the monthly payment unaffordable. But if the data were to show that we're seeing sales dips and Tesla's losing share not only to other EVs, but to internal combustion engines in the same categories, then that could be a cause for concern. And Elon Musk and Donald Trump's relationship could be the catalyst for that concern.
Hey, Seth, it's good to hear from you. Thank you, sir. Seth Goldstein there of Morningstar. The numbers dropping from Tesla a little bit later after the closing bout. That stock this morning in the pre-market, just a touch softer, no drama. We're down by 0.7%. With an update on news elsewhere this morning, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. Blackstone's chief executive, Steve Schwarzman, believes the U.S. will avoid a recession regardless of who wins the White House. He said both candidates have policy proposals that appeal to growth. Overall, Schwarzman has a relatively positive outlook for the U.S. economy. As rates fall, he sees improving environments for deals and exits. Qualcomm shares falling in the pre-market trade 4.4% rather. The British chip maker ARM revoked a license that allowed Qualcomm to use its IP to design chips. ARM has given Qualcomm a 60-day notice for the cancellation. Such a move would roil the smartphone and PC markets and disrupt the finance and operations of two of the most influential companies in the semiconductor industry. Frontier Airlines exploring a renewed bid for Spirit. The Wall Street Journal reporting that the budget airlines have had recent discussions about a possible merger. People familiar said that the talks are at an early stage. If a deal between the two carriers is reached, it would likely be part of Spirit restructuring its debt and liabilities in bankruptcy, according to those people talking to the Journal. And that's your brief, John.
Danny, thank you. So is that deal allowed? That one can go through?
Potentially. The JetBlue one, obviously, the FTC wasn't too keen on, but maybe that things are so bad for Spirit, they're going to have to let this go through.
So it's basically a threshold. How terrible is your business model? And if it's bad enough that you're not going to survive, all right, fine.
On the brink of bankruptcy or in bankruptcy, and
That's
we'll allow it to happen. OK, that's where the bar is. Up next on the programme, the easiest job in Washington.
It's the greatest job in government. You show up to the office once a month.
I have thousands of hardworking people. I can assure you that they work super hard every day, not just once a month.
That conversation up next. Session lows at the moment. Big morning for earnings. Equity futures right now on the S&P 500 down by 0.2%. Big afternoon for earnings as well. We'll hear from Tesla after the close. Then next week, my favourite week in earnings season. We hear from all the major players in big tech.
And that really will be the key question in terms of whether we are correct in saying that their heydays are past them, that basically they can't upgrade, beat and raise, can't be as much of a raise as it has been in the past. If that's not the case, can you imagine how much more people just rotate back into big tech?
I said all the biggest names in tech, and I should say, with the exception of NVIDIA, who needs to bring their earnings report forward, as we all know. Under surveillance this morning, the easiest job in Washington.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do?
It's the latest this morning. I took that personally too. It's kind of what we do every single month. The former president throwing shade at Fed Chair Jay Powell just last week. This week, ECB President Christine Lagarde jumping to his defense.
He should come and visit us. And, you know, I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month. I don't want to speak for Jay Powell, but I'm sure that's how he sees his job.
But I'm kind of speaking for Chair Powell. Joining us now, Mizuho's Jordan Rochester. Jordan, fantastic exchange between Francine Lacqua and Christine Lagarde just yesterday. I want your opinion on the following, a very pointed question. Who has the easiest job in central banking right now? Christine Lagarde or Jay Powell?
John, it depends on what you mean. So if you mean macro, I think the ECB have the easier job. Growth below potential, inflation below target, and all of the signals suggest it's not going to get better. So for them making the decision whether to cut rates or not, it was a bit difficult in September. It's become much more obvious now with that October cut. They should be cutting rates at every single meeting. In the US, John, much more cloudy because you've got this fiscal spending that's happening in the background. Even though it's waning, you don't have that fiscal spending that you have in the US in Europe. So Lagarde doesn't have the risk of really inflation bouncing back next year. I think that's a really low probability. But for the Fed, they do have that risk. And the labour markets continue to surprise us, even though all the data says from the surveys that they should get worse, they keep getting on better. So I think, John, the Fed has the harder decision on the macro. But in terms of the ECB, they've got 19 regional or national central banks to deal with, various different speeds, no harmonious union of the capital markets. So in that respect, it's harder.
So let's focus on the dollar side of the trade to begin with. Given everything you've just said, let's run with this. Let's say from your perspective, you have to confront the very real prospect of a red sweep. Let's see that's how things are playing out on November 5th overnight into November 6th. Do you think bond yields will be higher? I assume you do. Do you think that would be dollar negative or dollar positive?
That's one of the easiest questions, John. It's definitely a dollar positive because you're throwing tariffs on all your major trading partners. Now, the Eurozone doesn't have a free trade agreement. It would be in the sort of crosshairs of Trump if he was to come in. China's the clearer one. And when you have tariffs come into place, That lowers the competitiveness of the euro area, it lowers the competitiveness of China, and their currencies need to devalue versus the dollar, boosting the dollar to offset it. But then you've got free trade agreement partners. You've got Mexico, the land of great guacamole, but they've got a free trade agreement, and Trump wants to target his cars, their cars, that are coming into the US. So there's the risk for 200% tariffs on Mexican exports of cars. I think that probably won't happen. I think it's a sort of positioning for a negotiation of USMCA by Trump. But you're looking at dollar MEX, you're looking at dollar renminbi, you're looking at euro dollar and dollar yen. All these countries have the risk of tariffs, and it means their currencies need to weaken.
Jordan, it's interesting you say that's an easy one, because some people don't agree. And what was interesting from my perspective, listening to you speak, is you went straight to the trade story and didn't talk about the deficit story. And that's where my focus is. If you get a government that's going to issue a ton more debt, and we get the very real prospect of a buyer's strike in the bond market, I'm wondering whether we actually get that dollar strength. What's your pushback to that?
Pushback is tariffs require no congressional approval, really. On USMCA it would, but on China tariffs won't, so Trump can do that. He needs Congress to get most of that fiscal done. And the difference between Liz Truss and Donald Trump is it's quite a long process to do that fiscal spend. All the planning that will go into it, it will take a few weeks to a few months. And by that point, there won't be a buyer's strike, because it probably just won't happen that you have that size of fiscal spending that he's proposed. Where with Liz Truss, she just threw the budget out there. And we knew that she had a majority in Parliament, so it probably would get through if she had the opportunity before having to step down. And so, very different political landscape. You've also got the US being the reserve currency of the world, where in the gilts market, that isn't the case. So you've got a buyer's strike. In the US Treasury market, yes, you'll see steepening of the curve potentially with that fiscal fear, but it won't be a buyer's strike, because the whole global financial machinery uses US rates.
At the same time, Jordan, you have to wonder whether, that might temper how much yields can rise. But does that also temper how violent the move could be in FX? In other words, even if people do believe that the U.S. will benefit more, that other companies will suffer more from potential tariffs, that people aren't going to be as aggressively going into the dollar because maybe of these some concerns.
Well, let's split it into the election. It's quite clear to me the dollar has to keep rising for three reasons. One is the swing states are moving in Trump's favor. Two is you've got the data surprises in the US are pretty healthy. And third is it's that tap on the shoulder moment. If Donald Trump wins this election and you didn't hedge for it in your book, your boss will tap you on the shoulder and say, what were you doing? So you're having this basically consistent demand for hedges over the event. After the event, I agree, it gets a bit more tricky, but because we know the outcome, if it's a red sweep, you know there's a very high chance of tariffs going into place. So the dollar continues to strengthen. We're looking for 157 in dollar yen, 103 in euro, for example, if that was to happen. But then we get to next year. And I remember 2017, we got to the start of 2017 when Trump had just won in November 2016. Everybody was bulled up on the dollar, and it petered out, it turned lower and went lower. That's the risk, because it might be the case he softens his positions on tariffs. It might be the case that he doesn't get his plans through Congress. So I think next year will be a lot harder. And it might be the case that the dollar strength continues in Q1 and Q2, which is when I think the tariffs will probably happen. Q3, I actually think the European data, the Chinese data, will be bouncing back from the lows.
Interesting.
And so things improve.
Hey, Jordan, it's got to catch up. Got to squeeze in a congratulations for Aston Villa. You can run away with that. Jordan Rochester of Mizuho. Appreciate it, buddy. Thank you. Euro dollar 107.79. Up next, Kevin Gordon of Charles Schwab, Evan Roth-Smith of Slingshot Strategies, George Ferguson of Bloomberg Intelligence, Matt Hornbach of Morgan Stanley, and the latest numbers from Coca-Cola, just around the corner.
That move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation.
Growth has been much more resilient than people expected.
Taking the totality of the data, the mosaic of what's going on in the incoming data, it still tells me that we are in the no landing scenario.
You're going to have a recession to kind of clear the deck of all the abnormalities that are out in the economy.
Don't get over your skis, because this market is not contemplating any kind of growth slowdown or any kind of inflation reacceleration.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are poised for a third day of losses potentially. muted losses, but losses. We're down by 0.25% on the S&P 500 on a big morning for earnings in America. Numbers from AT&T, IBM, from Boeing, from Coca-Cola, from Tesla, from Coca-Cola. Alicia, just moments ago.
Yeah, coming out, beating across the board, talking about 77 cents, the earnings per share versus 74 cents expected. The revenue coming in $11.95 billion versus the $11.6 billion expected. Basically, this is a similar story to what we saw over at Heineken, where weaker actual unit sales were made up for by the increase in price. This from James Quincy, the CEO of Coca-Cola. Our business continues to demonstrate resilience in the face of dynamic external environments. So just talking, and maybe not talking about weakness, but their ability to really continue to raise prices stands out to me.
Things that the Starbucks CEO would love to say this morning, but cannot. Starbucks in early trading not doing so well. After hours yesterday, down pretty hard in the pre-market following numbers from that company. The numbers not pretty. Suspending guidance for 2025. The United States, softer transactions there, down by 10%. China down by 14%. The stock is lower by 4.6%.
A bigger question for Starbucks is sort of more of an existential question as Brian Nichols takes over as CEO and maybe clears the decks by withdrawing any type of guidance for the full year. But a question of what Starbucks is going to look like. Will there be fewer stores? Will there be more baristas? Will there be cheaper lattes? I mean, honestly, you start to wonder, have they reached the tipping point where people start saying, no, you are not going to buy another $7 latte. I promise you, if you come back with another receipt, I'm going to get very angry.
This is clearly very personal to your children, but it does feel like, is this the bottom for Starbucks, or potentially are they going to have more quarters of just less growth, less transaction? You look at the research, Morgan Stanley, remarkably poor. Jefferies, tough road ahead. Edward Jones, there's going to be some tough quarters moving forward. So it feels like they're not out of the woods yet.
The coffee's always been too expensive. That's not a new problem.
Yes, but there's a threshold.
The consumer experience is trash. That's the threshold.
Okay, well, that actually is something.
You walk in there, some of the stores are a dumpster fire.
You're correct.
It's been like that way for years.
Part of this is actually free bathrooms. I'm serious. I think that a lot of people go in there, and then it becomes sort of a question of who hangs out there. But I also think there is this issue of how many more baristas are they going to get in, and that certainly was an issue for Brian Nichols.
You're both sounding like my boomer father. And one is the issue is when you order Starbucks now, you can just do it on your app. So you walk in, it's there waiting for you. You literally can spend less than 10 seconds in the store. I don't know what you're complaining about.
And that experience is trash. I've seen it. I've gone into the store with you. It's all lined up, people's coffee, all sitting there in plastic containers.
Hold
you
on.
think that's
You
a
pick
premium?
it up.
You think that's a premium experience
It's
to walk
efficient.
in there and see that?
It's efficient.
John doesn't even drink coffee.
Look, clearly my view, I drink decaf. And clearly
Cappuccinos.
my view, I'm not lonely on this point.
No, you're not.
Sales were down.
Yeah, you're right.
Transactions were down 10%. You're looking at me like I'm nuts, and the numbers speak for themselves. The stock is lower.
And not just the numbers, but people who work at those stores also have been complaining that they're understaffed, they're overwhelmed, they have difficulty managing everything. And that, I think, is something that is a very big issue that Starbucks is looking to address.
You think Brian Nichols there because things are going well?
I think it's idiosyncratic to the Starbucks you visit. I only go to 2. And I know the people there, and I do it all on the mobile app.
Okay, let's see if you get a free coffee for this a little bit later. Starbucks is down by about 4.5%. Coming up this hour, Kevin Gordon of Charles Schwab as the equity market rally stalls. Evan Roth-Smith of Slingshot Strategies on closing arguments on the campaign trail. And Matt Hornbach of Morgan Stanley on why Trump 2.0 may not spell disaster for the bond market. We begin this hour with stocks and bonds heading for a third day of losses as the list of concerns continues to grow, including Federal Reserve policy and the election outcome. Kevin Gordon of Charles Schwab looking at one more potential liability, saying frothy sentiment is likely the biggest risk for stocks right now. Animal spirits are not back to their highs earlier this year, but they have moved into extreme optimism territory. Kevin joins us for more. Kevin, good morning.
Good morning.
How are you gauging that? How do you measure that? Extreme optimism territory.
We take an aggregate of attitudinal and behavioral metrics, so you can look at everything from AAII and what investors are saying on a weekly basis, whether they're bullish or bearish or in the neutral camp, all the way to actual positioning and fund flows into ETFs. And I know we talked about this last time, this kind of spread sometimes between what's going on in the attitudinal universe, what's going on in the behavioral universe. You're starting to see a little bit more pickup on the attitudinal side to match what has been still pretty frothy sentiment on the behavioral side. So if investors had been saying over the past couple of weeks or past couple of months that they hadn't been feeling as good about the market, their positioning didn't really reflect that. So it's now the case where, again, to the quote you just pulled, you're not yet back at that extreme optimism, sort of peak euphoria territory. You are hovering into that zone now. And really all it does is make the market more vulnerable to any kind of negative catalyst, whether it's geopolitical related, whether it's Fed related, whether it's economic growth related. You can take your pick because we've had all of those so far this year. But I think it's more important to assess that that's the backdrop. It's not necessarily this favorable backdrop of everything is sort of pessimistic, or at least trading in that pessimistic territory where you're not going to get as much of a hit in the face of a negative catalyst.
So with that in mind, what are you advocating for, particularly coming into a big event risk in 2 weeks' time?
I think, of course, the election can be a volatility driver. I do think some of the volatility that's come up to the index, not just stayed within sort of below the surface at the individual stock level, since the midsummer has been a good thing, because you're not going into the election with just this coiled spring of volatility. Even in the bond market, where you've had much more volatility than the stock market, if you're comparing the move to the VIX, I do think it's been actually a better environment where some of that has come up and bubbled up to the surface. Obviously, it's not great to go through drawdowns that are led by tech when you had that midsummer one and tech fell by 15%. But this has also been rotational in nature, where every drawdown that we've gone through so far this year, every period of weakness, there has been this offsetting strength from other parts of the market at times, and that's ultimately kept the indexes afloat. So even though you've had all this churn under the surface, I think it's a better way to go through some of these stealth corrections, or even for some parts of the market, these stealth rolling bear markets.
So I'll just ask you your own question. Is the 2-year-old bull too legit to quit?
Probably right now, yeah, I would say. What's interesting about this bull market, it's so unique in so many ways. The first year, I would characterize it as probably the weakest in history, because you had, at times, a record low percentage of companies outperforming the S&P, whether it was on a trailing 1 month, 3 month, 6 month basis. But in the first year, almost to the day, 2 sectors were actually down in the S&P, and it was staples and utilities. Not necessarily a terrible thing, because they're a little bit more defensive in nature, but you never really see that in a bull market. Even the defensive parts of the market do rally when you go into a period of strength in that first year of the bull run. So the fact that changed in the second year, where now they've started to catch up, in particular utilities have caught up, I think that's a relatively constructive backdrop. It probably shows that this catch-up momentum has some legs. But I think that, looking to the third year, historically, you do get more drawdown activity. You get a lot more volatility. It's less exciting. When you look at the earnings backdrop that we're in, things are less exciting from an equity market gain perspective. So I still think that there's, legs to this, but you could get bigger pullbacks, maybe associated with what has been a strong momentum trade, because the momentum factor is having its best performance and best year since 1999.
We've been toggling with this idea of at what point bond yields start to really impede on potential returns for equity valuations. And you have to think, for small caps and for the equal weight, you have seen underperformance in tandem with yields rising to the highest levels going back to July 25th. At what point does that torpedo the entire thesis?
I think it depends. So whatever the level of yields we ultimately settle at for this next peak, it depends how we get there and what's pushing us there. So if we get there in a really rapid pace like you had last summer, from July to October, when you got to 5% on the 10-year, and it was much more about inflation concerns and maybe the economy overheating, that I think is obviously a more sinister scenario. What has changed this time is sort of twofold. Number one, this relationship and the correlation between bond yields and stock prices has gone back into positive territory. So it's not as hostile anymore, where every single day you're seeing a rise in yields, you're getting the subsequent decline in stocks. The second thing is that you're approaching this from a stronger and a relatively healthier breadth standpoint. So you've still got, even after yesterday and the day before with the weakness in the S&P, 76% of members trading above their 200-day moving average. So the band that we've been in this sort of 65 to 80% range for that metric alone this year has been just a firmer backdrop. And I think it sort of helps keep you, out of the mud a little bit if you do get hit with some of these corrections or some of these catalysts to the downside. And that's what you've seen in the corrections this year. Max drawdown for the S&P is 8.5%. That's pretty great. So I think that as long as you stay in that environment, and now you've got some breadth catch up from areas like the Russell 2000 and parts of the NASDAQ, that probably keeps you in a better spot, even if yields continue to creep higher.
So you mentioned two catalysts, geopolitics and the U.S. election. What if the U.S. election, though, is not clear cut? In less than 2 weeks' time, you have Americans fully going to the polls, even though we have more than 20 million already voted. What if there's a contested election? What is the impact to the momentum on this market?
So, the tough part about that is that we don't really have a big sample size, and you can really only go back to one point in history where it was the 2000 election. And even that's such an interesting analog, and I think a non-analog in my opinion, because by the time you were going through that contested election, you were already in a bear market. Bear market started in March of 2000, didn't end until October of 2002. You had a recession sandwiched in between that from March of 01 to November of 01. So automatically right there, I think that sort of puts that aside as this clear analog. So I don't think that we can use any point in history, which I know is, the knee-jerk reaction of investors to do so. But, we're in a totally different economic environment. Even the election setup itself, the possibility for the House and the Senate flipping, and the possibility for, the president to become maybe the former president again or the current vice president now. There's so many nuances and differences that I don't think you can sort of look back at any point in history and use that as a guide.
Do you think people coming on this program and some of the hedge fund managers talking to Wall Street Journal, et cetera, saying they're putting on Trump trades, are they getting over their skis?
So I get confused about what a Trump trade is versus what a Harris trade is, because if you look at it from a sector perspective, and we often use the energy sector as a pretty clear, and I know it's been discussed a lot on this program before, but there was probably this conventional wisdom that when you had the Trump administration, it was going to be really pro-energy. You could look at the rhetoric, you could look at the policies. The reality is from inauguration day to inauguration day, 2017 to 21, energy was the worst performer. It was the only sector that was down. It was down by 40%. Vice versa, you can flip it on its head. Energy has been the best performing sector since Biden took office. So I don't, that argument in and of itself is kind of this clearest way of saying, I don't necessarily know what a Trump trade is or what a Harris trade is. I've seen everybody sort of put together, not everybody, but a good chunk of people put together these sort of old economy industries that would do well under Trump and vice versa under Harris. But you can look at just industry leadership throughout both administrations, and it doesn't really add up.
Is it easier to say that one is the status quo and one be a real game changer for the bond market?
Because I think
I
think it depends on what you're tying it to. If you're tying it to deficits and debt, there seems to be for a while now bipartisan support for who cares when it comes to spending. So I don't really know what the impact is going to be. Plus, we've done a lot of work on this. My colleagues, Lizanne Saunders, Kathy Jones, Mike Townsend, we collectively wrote an article back in the summer about looking at a lot of relationships within all the markets that we cover. Kathy in particular has looked at bond yields and inflation related to debts and deficits. And no matter which way you slice and dice it, the change in debt, the level of debt, the change in deficits, there is no strong correlation between that and yields or inflation. So I do think it's something to worry about. It's by definition unsustainable in terms of the trajectory we're on. But in terms of the market impact itself, it's really hard to tie that back to, in particular, the bond market and inflation.
Final question. How defensive are you about Starbucks coffee? As defensive as Anne-Marie?
I drink the coffee that we have at the office, so I'm neutral on this. Yeah, and at Bloomberg I drink this
Bloomberg coffee. So. The best, apparently. Kevin, thank you, sir. Appreciate it. It's good to see you. Thank you. Kevin Gordon there of Charles Schwab. With an update on news elsewhere, with your latest stories in your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Some earnings to get through. Hilton shares falling 4% in the pre-market. It reported revenue that rose compared to a year ago, but it fell short of Wall Street estimates. Despite adding new hotels, lower travel demand hurt Hilton and led to it lowering its 2024 profit outlook. Third quarter results were also hit from worker strikes and Hurricane Helene. Coca-Cola shares also lower this morning, 2.5%, reporting earnings moments ago. Volatile session this morning. It beat on third quarter earnings thanks in part to price increases, but unit volumes did fall. It lifted its adjusted organic revenue for the year to 10%, up from its range of 9 to 10. In the release, the CEO said that the business continues to demonstrate resilience in the face of a dynamic external environment. Apple CEO Tim Cook is meeting with the top technology officials in China. In his second trip to China this year, Cook pledged to deepen Apple's investments into the country. They also reportedly discussed cloud services and cybersecurity. China remains Apple's most important market outside of the U.S. iPhone sales, 16 sales that is, they are up 20% compared to last year's model. And that's your brief, John.
Danny, save me. They're dropping F-bombs about Starbucks around the table.
Well, you brought it up.
Up next. I'm doing a tease. Up next. You want to jump in more on coffee?
Well, I'm a niche user, as you say. I like the coconut milk cappuccinos. Can't really get that everywhere.
That's going to get Brian Nickel paid, that's for sure. Up next, closing arguments on the campaign trail.
My plans are focused on working people, the middle class, and what we must do to strengthen hardworking people.
With 4 more years of Kamala Harris, North Carolina will be an economic wasteland. That's what's going to happen. We don't need another 4. No country could take that.
That conversation up next. Equities on the S&P 500 just a little bit softer. We're down by 0.2%. Under surveillance this morning, closing arguments on the campaign trail.
My plans are focused on working people, the middle class, and what we must do to strengthen hardworking people to be able to do what they dream and aspire to be able to do. His plans are about giving tax cuts, massive tax cuts, to billionaires and big corporations.
With 4 more years of Kamala Harris, North Carolina will be an economic wasteland. That's what's going to happen. The rest of your companies are going to move out. Everybody knows that. The smart people, we don't need another 4. No country could take that.
So here's the latest. Kamala Harris and Donald Trump are looking to sway voters with less than 2 weeks until Election Day. Pollster Evan Roth-Smith writing the best testing closing arguments against Trump are those that emphasize his lack of support from his former cabinet and numerous Republicans. Slingshot's Evan Roth-Smith joins us now for more. Evan, welcome back. It's good to see you.
Thank you.
I see commercials like that absolutely everywhere, which begs the question, if that's the best testing case, why is this race still so tight?
Well, the race is tight because the electorate is tight. We have a structure in our electorate right now where Democrats need to overperform at the national level to even have a chance in the swing states. And every poll shows this closing up to a very, very tight race. This is what every pollster has been saying for months, right? This is going to, not just pollsters, it's going to be a 50-50 race. It's going to be really, really tight, but now we're living that reality because the polls have gotten there.
Evan, you say this is their best test in terms of their message they need to get out. And it comes at a time when you have John Kelly speaking to the New York Times, and he basically says that Trump is the definition of fascism. Mm-hmm. Is this, though, diluted in the sense that we have heard this for years for members who were part of Trump 1.0?
Well, so this was the best testing closing argument we had in terms of going after Trump, right? The kind of language you saw from her around her mission, her goals around the economy, around working people, and Donald Trump as a patsy of the wealthy and who will cut taxes and who will be fiscally irresponsible as well, as sort of the undertone to that, is still the best thing for her to say about herself. But yes, many people in the electorate are worried about this. Nikki Haley voters, people who supported her in the primary, who are Republicans instinctually on policy, are worried about things like a former Trump White House chief of staff coming out and saying the guy's a fascist, don't let him back in.
They've been doing a lot of campaign events with Liz Cheney, but then you hear from Governor Tim Walz, who says, well, we want her to be a part of Kamala Harris's campaign to talk about the fact, to give basically this idea to Republicans, it's okay, you can vote for Kamala Harris. At the same time, he said, we're not going to take any of their foreign policy advice. Mm-hmm. So what are you getting if you are, say, a Nikki Haley Republican and thinking about voting for Kamala Harris?
You're getting some sense of security that the Democrats are not this foreign entity that you can't cross over, that it would be verboten for you to cross over to. Nikki Haley voters, in our polling, these people are really Republicans. They're Republicans on economic policy. They're Republicans on immigration policy. They're Republicans on just about everything. They love George W. Bush. They love Condoleezza Rice. They love that era of Republican politics. And there's a lot of push out of the Republican Party from Donald Trump on them. They do not like Donald Trump. But we need to establish some pull into the Democratic Party if they're ever going to cross over, because they've already voted against Donald Trump once in the primary. And what the Democratic Party needs to do is to get them to vote against him a second time. That's a fairly tall order, but you need to make them comfortable doing something that their entire lives they've rarely done, which is vote for a Democrat for president. And that's what Liz Cheney is there to do.
Kamala Harris was asked on The View what separates her from Joe Biden. She said, well, really nothing really comes to mind. How bad was that for her?
That was pretty bad. We tested it out. It was the worst possible thing she could have said in that moment compared to the other things we tested.
Why wasn't she prepared for that question?
I think she was prepared. I just think she has hang-ups, and I don't think they're ill-considered or dismissible around how it's perceived for a vice president to be disloyal to their president. Also, by the way, for the first female vice president to be disloyal to their president, for the first black vice president to be disloyal to their president. It's sort of a cruel joke of history that to elect the first woman president, she's now been tasked in the final weeks with some supreme act of disloyalty against Joe Biden, right? That's pretty messed up. But she's dialed that answer in, right? We saw yesterday in that NBC interview, I believe, she gave a much more pointed answer about price gouging and housing prices. So she's gotten there. She's gotten more comfortable with it. But she's a loyal, dedicated member of this administration.
Do you think that it's a good thing for her to go on Joe Rogan's show after Trump?
Yeah, I think it's a great idea. I think she should absolutely do it. Not just because any time that she goes out and does an interview and talks to people, it works. We tested all sorts of clips, even moments we didn't think were particularly good from those first rounds of things she did with people like Oprah. And 60% of anyone of voters who saw clips of her doing interviews were like, that was great. Even if those of us in the media and politics would have gone, I would have tweaked that this way, that way. So when she goes on these media appearances, it works for her.
At this point, we are seeing the polls seem to favor Donald Trump. We're seeing that pretty much across the board. You're kind of nodding back and forth. Last time you were on, you said that you think pollsters are so self-conscious about getting it wrong in terms of not skewing the data enough to Donald Trump that they're actually overweighting him. Do you still think that?
I think the odds of an error in this election, a polling error, likely are a polling error in favor of Kamala Harris. And there are a couple pieces of evidence that might support that. One is, frankly, the last time we had a black candidate at the top of the ticket. Barack Obama in 2012, polling underestimated him by 6 points in any given swing state. Because polling is good at establishing what a given electorate is going to do. It's not always so good at picking up at changes in the electorate, like the kind of high turnout you get from black voters when there's a black president on offer. And the other thing is the last election we have, the 2022 elections, was a polling miss in favor of Republicans, right? That overestimated Republican support. So people like to talk about the 2020 miss, the 2016 miss, but the last national election we had in the 2022 midterms was a large multi-point miss that overestimated Republican support. So I think there's plenty of reason to believe that if there is a polling error, and by the way, I don't think there necessarily will be a polling error, but if there is one, that Kamala Harris is a likely beneficiary of that error rather than someone who will be punished by it.
We've got to squeeze this in. This weekend, Harris is in Texas. Donald Trump is around the corner at Madison Square Garden here in New York City. What is going on there? What do you think that's all about?
It's the attention war. It's the attention war. You can go to Wisconsin 20 million times. You can go to North Carolina 20 million times. But these closing weeks of the election, you have to get into people's living rooms. Not just the people who come out to a rally to see their favorite candidate. You have to get attention. You have to get chyrons. You have to win the news day. And doing a big rally at MSG or doing a big appearance potentially with some sort of celebrity maybe in Houston is a way to do that, and a way to at least, these people have jets. They can go back into the swing states the next 5 minutes. So winning the attention battle with a couple hours of your time and then going back to the campaign trail is not a silly way to spend your time.
It's getting a lot of attention, that's for sure. Evan, it's good to see you. Thank you, sir. Evan Ross-Smith there of Slingshot Strategies. Up next on this programme, Boeing results just after the commercial break, plus an update on the health scare over at McDonald's. That stock is down by almost 7%. In a pre-market. From New York, with equity futures on the S&P 500 negative by 0.2%. Bond yields just a little bit higher, through the curve up a single basis point. The 2-year out to 30s, 10s at 4.22, a 2-year at 4.04. From New York City, you're watching Bloomberg TV. Numbers from Boeing dropping any moment now. Equity futures on the S&P 500 down by 0.2%. On the Nasdaq, we're down by a third. On the Russell, down by a third of 1%. Also, plenty of earnings through the morning. We've heard from AT&T and Coca-Cola already. No real drama from either of those names.
No, although what you could see is AT&T just getting pressured a little bit on equipment sales. I want to dig through that to understand what their iPhone sales and their financing is like and their partnerships there. With Coca-Cola, they're able to raise their prices to offset some lower volumes, and that, I think, is pretty interesting.
Tesla coming up a little bit later after the closing bell. Boeing just crossing at the moment. Just seeing a headline from the CEO. Boeing to reset priorities and create a leaner organization. Lisa's got the numbers.
Yeah, revenue for the third quarter is $17.84 billion. The estimate is $17.89 billion. The third quarter negative operating cash flow was $1.35 billion. The estimated was a negative $1.99 billion. So less of a loss than people had expected. The new Boeing CEO, Ortberg, saying that they need to improve execution discipline. But to me, what this really highlights is it sort of staves ease off some of the worst case scenarios. The third quarter negative adjusted free cash flow was $1.96 billion. The expectation was for less than that, a lesser negative of $1.87 billion. So still some issues they're working through.
That stock is down by about 0.5%. To work through the numbers with us, I'm pleased to say that joining us is George Ferguson of Bloomberg Intelligence. George, Lisa went straight to that free cash flow number. Walk us through what you were expecting relative to what we got.
Yeah, so I thought it was decent numbers, right? So I think the market's really focused on his cash flow. I think cash flow could have been worse than that, about negative $2 billion. I think when you got to the free cash flow line, because I think we're very concerned about the amount of money they need to run the company. We knew they were at about $10.5 billion in cash balances. That's about the bottom of what they need, to run the company. That's why we've seen them file the shelf offering for the $25 billion. I think they may wait and see if they get a positive union vote today to decide how much they want to go into the marketplace and raise, equity. There'll be some pretty heavy dilution. There's only, about $90 billion in market cap last I looked on this company. You raise $25 billion. That's really, that's over 25% dilution. I think something you don't want to do to the existing shareholders. And frankly, I thought, revenue numbers not bad. The second quarter really wasn't bad for deliveries. It was lighter than we expected. The longer the strike drags on, the more we get concerned that it's harder to restart the supply chain and get moving back towards 30 plus 737 deliveries a month. That's the secret to the recovery. And so I guess, for Kelly Ortberg, really all the action is tonight. And it's all about how that union vote comes in and whether or not they can restart some plants, try to get happy union workers back into the factory.
George, we can see that the shares are kind of fluctuating between gains and losses as people try to understand how the actual earnings stack up with some expectations that have been lowered again and again and again. George, when you look at the line items, this is not great performance pretty much across the board. A miss for defense, space, and security revenue, a miss for global service revenue, a miss for negative operating cash. A lot of questions here about how much you end up with a company that has cut costs, not necessarily paying some of the workers who are on strike, but really don't have any growth. How can Kelly Ortberg really give a sense of what this company is going to look like, what the growth engines are going to be in a couple years' time?
He can't. Well, today he can't, right? And so again, I think the whole path forward, the entire recovery is all built on getting those union members back in the factory, but getting them back in at a wage rate and at a benefit level where you can still make money in this business. And then he's got to start to build 737 airplanes. That's the whole path. And so, like I said, a lot of sort of 2Q is rearview mirror. It's all about getting this union contract done. You gotta, you gotta think about this. These airplanes are almost custom made, right? There's automation on these lines, but these are skilled workers that put these airplanes together. He has to get them back into the factory and happy and excited about making Boeing airplanes, not just drag them in, barely. And so that will be a lot of the challenge here too, as he gets an agreement, goes for an agreement with the union.
So 5 p.m. Seattle time, you said that's when the fireworks are going to be. Do you think the agreement that's been discussed gets it done?
It's close. Look, I think the union members have been out of work for about a month. I don't know that I could survive a month without a paycheck, without health care. They got up to 35%. I think they may have wanted 40. It's pretty darn close. They gave him a sweetener on the 401k. I think he's going to get it, but it's close.
We'll see a little bit later on. Appreciate the update, George. Thank you, sir. George Ferguson there of Bloomberg Intelligence. That stock just about unchanged. The big decision, really, bigger than the earnings, is whether we can actually strike a deal and that company can get back to trying to produce some planes. And based on some of the commentary this morning, maybe in the future design a brand new one. Lisa, this goes to your point, and you've been focused on this, I know, over the last month or so, defending that investment-grade credit rating. This came from Kelly Ortberg. I'm confident that we have a good path forward to manage the realities of our business and retain our investment-grade rating.
This is a huge issue for borrowing costs, especially at a time where they need to raise capital. We saw that with the stock share sale. How much are they going to end up in this sort of spiral downward where their costs of interest payment are going up at the same time that they need to borrow to invest to start creating that new model that you're talking about? And that's, some of the hangovers that this company has to deal with, even as they just try to get production back online with their workers.
This is a stock to watch going into the opening bell and after hours as well when we find out the outcome from that vote. Two other names to watch going into the cash open. McDonald's under pressure after an E. coli outbreak tied to the company's quarter pounder hamburgers sickened dozens of US customers. The CDC saying one person is dead. The stock is down by close to 7%. Elsewhere, Starbucks pulling its guidance for 2025, with sales plunging for a third straight quarter, demonstrating the scope of issues facing new CEO Brian Niccol. That name is down by 4%. Joining us now is Michael Hayden of Bloomberg Intelligence. Michael, we'll split these two stories up because they are very, very different. We'll get to Starbucks in just a moment. McDonald's, stock is getting hammered. What's your view on what's taking place and how quickly this company can move past it?
Yeah, they're going to be in the penalty box for a while. It was a tragedy. Obviously, there's going to be a ton of bad press around it. The most recent one we can look to was Chipotle. Their same-store sales dropped for 5 straight quarters. They dropped 20% in 2017. I don't think this will be as bad because Starbucks was kind of unique. There was rolling issues right after the E. coli, then norovirus started to pop up in a bunch of different stores, and so that caused the issues to kind of extend a little bit longer. Also, it was a more complicated situation at Starbucks, right? Their food is out in the open behind a sneeze glass, right? And so there's more opportunities for pathogens to get into the food make line. Whereas, McDonald's, we think this could be an easier solve. If you just start grilling your onions, that would take a lot of the risk out of the situation for them. So, what we wrote yesterday was that we think sales and traffic will probably be impacted for about a year.
For a year. Mike, you're saying that it's not necessarily the same as Chipotle, and Chipotle had a much longer runway in terms of it needing to heal some of its relations with its customers. For McDonald's, how much does this raise a question about supply chain issues and what kind of scrutiny there is over some of the suppliers, since this was a specific supplier that they believe who supplied the sliced onions?
Yeah, well, there's no doubt that this is going to have to be addressed, right? And management is going to have to do a good job on this upcoming earnings call, making people aware, and then also through their PR arm, make people aware that they're doing the correct things in terms of food safety, to make sure that the food that they're serving is okay. And so, listen, it's unfortunate that it happened. It's a big risk in this industry. It's one of the worst things that can happen for a restaurant chain, right? And so they're going to have to, I guess, pay their penance and prove to customers in the street that they're doing the right things to make sure that their customers are safe.
Also bad when it happens to companies that people wake up and realize that $7 is too much to pay for a vanilla bean latte. And that's sort of a question around Starbucks, this question of how much they have to completely rejigger the business model at a time where sales are slumping 10% in the U.S., 14% over in China. Yes, a new CEO suspending guidance. What's your takeaway of how significant the overhaul of the business model has to be in order to bring it back to its former dominance?
Listen, it's a big lift, but this preliminary earnings release doesn't change my opinion of Brian Niccol or his ability to turn this around. It doesn't make me any more concerned, right? To me, this is old news. He's been in the role for a month. Anyone who's been following this story knows how bad the last few quarters have been. We've been writing for over a year now about weakness this fiscal year, right? And so this wasn't a surprise to us at all. If I'm Brian Niccol, and actually it's not a bad thing at all because he's got easier comps to lap for next year, and we think that they can post positive same-store sales growth here in the U.S. and China, partly because they're lapping such weak results from this past year, but then also by instilling a culture of accountability, transparency, trust, right? Getting the right members of management in the right positions, right? He made a switch in China, and they just hired a chief marketing officer, and they're also going to ramp up ramp up the marketing once they get the operations right. Yesterday on his video, he talked a lot about reducing the number of SKUs and the number of drinks that they're making because, as I'm sure you've heard over the last year, there's been a lot of new items added to the menu, a lot of new limited time offers that made baristas' jobs really difficult.
Maybe
right?
too many new items. Michael, what market do you think is easier for the new CEO to turn around, China or the United States?
I'm going to say the United States because he has a ton of experience in this market. So I would go with the United States. I'd say China's a little bit more difficult because the gap between their price gap between them and their competitors is just very, very wide. I mean, they're selling coffee that's sometimes 3 times more expensive than Luckin and K Coffee. And so I think China's going to be a much tougher turnaround than the United States.
Michael, appreciate the update, sir. Thank you. Michael Hayden there of Bloomberg Intelligence. That stock recovering just a little bit. It's down by about 3% in the pre-market. Under surveillance this morning, Boeing reporting third-quarter results that missed Wall Street estimates. In his first public presentation, CEO Kelly Ortberg saying the company has, quote, some really big rocks that we need to get behind us to move the company forward. Factory workers will vote on a new contract proposal later today in hopes of ending a 5-week-long strike. That name is down by 0.4%. Elsewhere, Secretary of State Antony Blinken in Saudi Arabia as the administration continues to push for a ceasefire between Israel and Iranian-backed militants. Blinken reiterating that Israel shouldn't retaliate after Iran's missile attack earlier this month.
So you have the Secretary of State now going to Saudi Arabia, going to be seeing the Crown Prince Mohammed bin Salman. Again, his 11th trip to the region since October 7th. He's come back empty-handed every single time. But I think this trip is very different. We are less than 2 weeks out from the U.S. presidential election. I think this administration is just buying time. And Israel cannot retaliate with the Secretary of State in the Gulf.
Can't they?
I don't think so. I think that crosses a line. Maybe when he leaves, but...
We've crossed a lot of lines over the last few months, that's for sure, haven't we?
It would be very convenient if this got resolved and the Middle East had a peace deal before November 6th, November 5th. I don't think that that's necessarily going to be so easy to get right now, given how quickly things have been escalating.
One final story here for you. ARM Holdings is scrapping a license that allowed longtime partner Qualcomm to use IP to design chips. The move ratcheting up a legal battle between the firms and also threatening the semiconductor industry. Qualcomm sells hundreds of millions of processors annually. Both of those names down this morning.
What's so interesting about this is it goes to the question of Apple trying to integrate artificial intelligence versus Samsung and the Android. Qualcomm provides a lot of the AI-related features for Android phones. If they can't use this key feature, how much does that diminish their ability to inject AI types of technology at the same time that Cristiano Amon came out and basically said, we're on it. Everyone's going to have AI on their phones, and we're going to be the leading ones on this.
Don't have much AI on my phone. Don't know about you.
Well, I mean, a personal assistant. If it could make a coffee, if it could make a vanilla latte for $4, I would put it on my phone.
Back to the coffee again. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bank of America CEO Brian Moynihan is urging the Fed to be more measured. He spoke exclusively to Bloomberg on a trip to Australia.
So we've got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
Moynihan said that he expects the Fed to cut rates by 50 basis points by the end of the year. Texas Instruments rising in the pre-market trade 3.2%. It reported positive third-quarter earnings that helped overshadow the U.S. chipmaker's disappointing forecast for the fourth quarter. Texas Instruments CEO said that the timing is right for recovery following 8 straight quarters of revenue decline. Nielsen says that Game 5 of the WNBA Finals was the most viewed in 25 years. Viewership peaked at 3.3 million viewers in the decisive game between New York and Minnesota. Overall numbers for this year's finals came in up 115% compared to last year's. Fans who tuned in were treated to an electric overtime finish that saw New York take home its first ever title. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, dissecting a bond market sell-off.
I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. I think the market's going to get back to what is the foundational elements of the markets that we're seeing today.
That conversation up next, live from New York City this morning. Good morning. Treasury's down once again this morning. Yields higher by 2 basis points. The 10-year 422.76. Under surveillance this morning, dissecting a bond market sell-off.
I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. It would seem unlikely that the bond market and the equity market would be pricing in today a more complete picture of how this election is going to unfold. There's going to be the knee-jerk reaction, as there always is. We could get a bear steepener of the yield curve in the event of a Trump victory. But then I think the market's going to get back to what is the foundational elements of the markets that we're seeing today.
Here's the latest. 10-year Treasury yields trading near 4-month highs as investors confront better economic data and the prospect of a Trump 2.0 presidency. Morgan Stanley's Matt Hornbach thinks the bond market is less exposed this time around, writing, many investors see the Republican sweep outcome as most bearish for U.S. Treasuries. We think any rise in Treasury yields would be more contained than in 2016 based on a comparison between expectations for Fed policy today versus then. I'm pleased to say that a good friend of ours, Matt Hornbach, joins us now. Matt, let's jump into that story together. Give me some more detail on that. The bigger difference now, between now and 2016.
Yeah, John, well, the differences extend well beyond what people expect the Fed to deliver over the course of the next couple of years. But certainly the Fed is a very big part of the story. In 2016, we have to remember that, Janet Yellen's Fed was about to embark on a rate hiking cycle. It was the second time they were trying to start it up. And investors generally expected the Fed to be hiking rates very gradually going into that election. In the wake of that election, of course, investors changed their minds very quickly. And over the course of that next year, revised higher their expectations for Fed policy to the tune of about 1.25%. Now, 1.25% doesn't sound like that big of a deal today because we've just lived through 525 basis points worth of rate hikes in 2022 and 23. But back then, 125 basis points was quite a big deal. And so if we take that number, John, and we apply it to today's environment, that would essentially be the same thing as saying that investors would go from expecting the Fed to cut rates modestly to no more rate cuts in this cycle. And that's a leap that I don't think investors are going to make in this particular cycle, which ultimately means that the bond market sell-off will be more contained.
Matt, there's an argument that this time is different because the deficit is different. It's significantly bigger. We just had a cycle where we got fiscal stimulus into a growing economy, a healthy economy by many measures. Why is the deficit issues not a concern for you? And I'm not talking about the short end or the specific rates tied to Fed policy, but the long-term rates that are more hinged to the fiscal outlook potentially.
Lisa, I'm really glad that you asked me this question. I have a strong view that in the end, what moves the bond market are how investors change their expectations for fiscal policy or for Treasury supply. And if you ask every investor in the marketplace today whether we are going to have bigger deficits in the future, irrespective of the election outcome, to a person, you will hear the view that, yes, we will have larger deficits. It's already expected by most investors, and therefore it is already in the price to a certain degree. And the question then is, what type of deficits do we get over the next 5 years relative to what people expect already? That's going to be the most important part of the bond market reaction to this election. And so in the end, it's how people's expectations change vis-a-vis the deficit is what ultimately moves bond markets in any given period of time.
That said, Matt, given how bearish some people are getting on bond yields and the expectation we heard from T. Rowe Price that potentially we could get 5% on a 10-year yield, how aggressively are you buying longer-term bonds right now on some of the backup?
Yeah, well, look, I certainly think that there's value in the Treasury market, but a lot of that value depends on knowing an outcome that at this point in time is unknowable. So what we've been telling investors is to hug their benchmarks tightly. and wait for the opportunity to arise in the wake of the election, an outcome of which is very uncertain. In addition, the timing that we will know that outcome is also somewhat uncertain, and therefore, I think investors are best placed to hug their benchmarks tightly. And so, in terms of the duration exposure, Lisa, it's really about where you think any additional Treasury supply will come. And in the end, when the Treasury increases coupon issuance, they don't do so just in the 30-year Treasury bond. They increase supply generally across the yield curve. And so for investors out there who are worried about higher deficits, who think that those deficits will be larger than the marketplace is priced for, my recommendation is to be underweight the intermediate sector of the yield curve, not necessarily the long end, because in the end, when the Treasury increases supply, they're going to do it across the curve. And so the weighted average of that supply is going to hit most strongly in the intermediate sector of the curve, the 5 to 10 year sector.
Matt, I've got 40 seconds left. I want to squeeze this in. Dollar stronger against everything in G10. The intraday chart of dollar yen today is just this slow and steady march up and to the right. 152.96, about to break through 153. What's the story there?
Well, I think largely the story is the U.S. economy has once again proven more resilient than fears had suggested. And as a result of the interest rate complex moving higher, taking real returns in the U.S. higher, that's going to attract capital into the U.S. It's going to put upward pressure on the U.S. dollar. Of course, just like there's some degree of a pricing of a potential election outcome, there's probably something going on in the dollar just the past week, really, that is perhaps putting some higher probabilities on an outcome involving tariffs. And a lot of investors think that the dollar is going to go up on tariffs.
Matt, appreciate it. Matt Hornbach of Morgan Stanley. That's one to watch today. Close to 153 on dollar yen. Up next, Alicia Levine of BNY Wealth. Republican Senator Thom Tillis of North Carolina, Francis Donald of RBC, and Troy Gayeski of FS Investments. The third hour of Bloomberg Surveillance, just around the corner.
The US equity market has done so incredibly well. It's been an incredibly strong performing market.
I do still think that corporate earnings are actually still doing quite well.
At the end of the day, valuation does tend to matter. I don't think valuation is dead.
We think that valuation discipline probably is the most important thing to have at this time.
Focus is so much on the Mega 7 and following the trend there that a lot of these different pockets of the markets are beginning to see some fundamental momentum.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. 90 minutes away from the opening bell. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 just a little bit softer. We're down by 0.2%. The first back-to-back losses on the S&P since early September. I didn't realize it's been that long. That's quite a stretch. The S&P this morning, a little softer on the Nasdaq, down 0.4%. We've talked lots about the earnings today. The calendar's absolutely packed. After the closing bell, we'll hear from the likes of Tesla. We'll hear from IBM. Already heard from Boeing, AT&T, and Coca-Cola.
Yeah, some disappointments here. Boeing obviously is in a world of hurt, and they continued that world of hurt with some disappointing numbers, in particular about free cash flow being more negative than people previously expected. AT&T, just a marginal disappointment. I thought that it was interesting what we got out of some of the consumer-facing brands. The idea that we do see on the margins some negativity, even unit sales in Coca-Cola coming in a little bit soft, but they were able to raise prices in order to offset that. So again, still pricing pressure, but consumers, I don't know, the $7 latte. I don't want to keep going back to it. I'm not going to do it again.
Don't get Anne-Marie started on the $7 latte. So
Okay.
defensive about Starbucks this morning. I've got no idea why. We'll get to that a little bit later. Let's get back to the macro. Through the week, you're going to hear more and more headlines from central bankers and government officials from the IMF World Bank fall meetings down in Washington, D.C. Bramo's going to be down there. And this is how they kicked it off. By lowering its global growth forecast for next year, the risks are building up to the downside. There is a growing uncertainty in the global economy.
And they talk about the $100 trillion of global debt and how the fiscal overhang is creating a bit of a problem. They also talk about geopolitical concerns, not necessarily downgrading U.S. growth and the whole overall year forecast pretty much in line. But how much do they sort of present a remedy to it at a time where some of these global organizations don't have the same kind of clout? You hear about what's going on over with the BRICS conference and Vladimir Putin talking about how this truly is a multipolar world. How does the IMF grapple with that?
And also at the same time, Kevin Gordon coming on and saying, yes, this very bullish momentum right now, but two massive catalysts right now. One, geopolitically, what's going on in the Middle East, but then also the U.S. election. City out today, directionless. A dearth of data and polls that show a close presidential election have left markets without a clear direction. Even though some people coming on saying it's a Trump trade, really is it? Or is it just the fact that it doesn't matter who's going to be winning, there's going to be a lot of spending?
There's a quote that jumps out from the IMF that I want to share with you all. There is a rise of protectionism, protectionist policies, disruptions in trade that could also affect global activity. For who? And it just made me think yesterday, after we just had a conversation with Torsten Slock of Apollo, who's talking about a no landing in the US economy, and none of that stuff came up. I just thought, our policies, your problem. That seems to be the message coming from the Trump campaign to Washington, D.C. and the IMF World Bank, full meetings.
And Wall Street strategists saying, yep, that's pretty much what's going to happen. That's the reason why the dollar is expected to strengthen. That's the reason why a lot of people are looking at how to build out in the U.S. It does raise a sort of awkward moment to be having these meetings in Washington, D.C. for the IMF, talking about protectionist policies at the same time that has been carried through with this administration as well. And that, I think, is going to be a real tension that needs to be tossed out.
Exactly. So when you have them coming out and they say tariffs are going to be bad, they're going to be bad for the rest of the world. Well, this administration also kept tariffs in place. So yes, they might be more drastic under the former president, but you can't say there's not going to be tariffs or export controls or the idea of an ally not being able to buy a U.S. company under the Democrats as well. There's protectionism across the board.
Have you noticed it's a tax when they do it, but it's national security when we do it?
It's branding.
Yeah, there is a real branding difference down in Washington, D.C. Equity futures on the S&P 500, negative by 0.25%. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth as markets pause on Fed cut fears. North Carolina Senator Thom Tillis on Hurricane Helene recovery efforts, and Francis Donald of RBC on the shape of the U.S. economy. We begin this hour with stocks lower and bond yields inching higher as investors rethink Fed policy and the prospect of a second Trump presidency. But Alicia Levine of BNY Wealth seeing opportunity, writing markets have not lived up to the September dread and October flush. As previous years, we think the market melts up into the end of the year with some volatility around the very close election. Markets like certainty. Alicia joins us now to provide some of that certainty. Good morning.
Good morning.
Good to see you. Got to get into the election. How much of what we're seeing, cross-asset, in foreign exchange, in bonds, is the so-called Trump trade making a comeback?
So I wouldn't say it's a Trump trade. I would say it's the polls have moved slightly in Trump's favor. And so the trades are being put on. And if you look at what happened in 2016, the dollar strengthened, the banks skyrocketed. That's already happened before the election. So the trades early. And I think some of the bond yields as well that we've seen in the last couple of weeks is also part of thinking about some of the inflationary aspects of whoever wins this election. So, there's inflation on both sides of this. I think but everyone, to the extent that, people may be doing a Trump trade, I think it's overdone given the 50-50 nature of the polls. I mean, the pollsters are telling you they don't know who's going to win this thing.
You remember that morning in November 2016. We all do.
It was a long night.
At the time.
It was a long night.
I was up all night. We all were. The equity market was down. It was down hard. And then I remember that sort of acceptance speech, and he starts uttering things like infrastructure spending. And this market just rebounded. It got bought aggressively, and the Trump trade was off to the races, and everyone got on board. Do you see less chance of that happening this time around? Because Matt Hornbach of Morgan Stanley was making the point, like you have just now, that perhaps we're better prepared for this than we were back in 2016.
Well, we're more aware of it, and the market's already priced some of it in. And so you're not going to get those sectors or that immediate reaction, because if it's already priced in, it's not a surprise. And markets, if they price it in, the event itself is sometimes sell on the news. So I don't think this is going to be a great momentous thing. I think that we've been telling our clients that never to invest with your politics or what you think the politics are of the moment, because ultimately, if you take 2 steps back and look at the markets over a cycle, the politics or the political configuration actually does not affect your assets or your asset classes or the stock market. That is a very important thing to keep in mind as we head into the last 2 weeks of this election cycle, where people are feeling hot, depressed, thrilled, a combination of both, worried. It doesn't matter to market performance. It's the fundamentals of the U.S. economy and earnings and interest rates. That's what we focus on, and that's where we try to keep our clients.
So you see buy on the rumor and buy on the news, basically buy maybe even more on the news, at least in equities. I'm wondering if it's the same in the bond space at a time when you've been selling on the rumor. Some people are speculating you sell more. Matt Hornbach pushing against that, saying we all know this and it's nothing really that new. How much can you get that rally in stocks if you don't get a commensurate rally in bonds?
So I don't think the bond move is going to be dependent on who wins the election. Like, we've just moved 60 basis points on the 10-year. That's a pretty dramatic move. So one could say the move has been done as it relates to pricing in what's going to happen with the election. Ultimately, I think the deficit and the debt are bigger issues than who wins this election here, because, as I said, if there is a divided Congress, neither of these two candidates, whomever wins, is going to be able to get their full spending plan through. It's just not going to happen. So there's going to be a little bit more of a ceiling on what each candidate can do as they win. But again, that's with a split Congress.
But I guess that it just goes to this question of, we've seen the rotation kind of rotate back a little bit with big tech outperforming over the past few sessions. And I'm just wondering whether that's the new trend, the new sort of narrative in markets, if we do get a sustaining of these types of yields.
So, as we've spoken about many mornings at this wonderful table, we see tech both as defensive and offensive. And right now it's playing the defense because of the cash flow and the earnings and the margin, and being entirely not connected to what's happening in the bond market because they can run their businesses without borrowing. So to that extent, like, if you look at the beginning of the fourth quarter, tech has outperformed. It's outperformed because it's sort of been, the third quarter was all about cyclicals. It was about value. It was about financials coming back. And then you saw that, the tech take over again for the fourth quarter. I think you're likely to see that into the end of the year, because if there's any uncertainty at all at outcome or policy, it's the safety trade, right? These large cash flow generating companies that can protect your portfolio. That's where investors are going to go, I think, until there's some certainty on outcome and policy.
So basically, if there's uncertainty for a few days, you don't know the outcome of the election, or it's a contested election, tech does well?
I think tech does well.
So is that what you want to be buying if you're very concerned? Do you think this drags on for weeks or months?
We don't do election trades. We just think that the market will be fine because tech is, between communication services and tech, IT, it's almost 40% of the S&P. So we think you're protected there.
What else?
It's more about, this is why you shouldn't sell the market if you're nervous over election results, because the strongest and best companies which play defense in uncertain markets with strong dollar and high yields can do well in that environment, and that's where investors go. So it supports the index.
Last week, we saw the oil market, speaking of hedging and protection, we saw the oil market pull back some 8%. Even though we have serious risks going on around the world, especially in the Middle East, that could potentially have supply disruptions. Do you see that it's underpriced right now, that risk premium?
So, no, because we have enough supply. And it seems that the China stimulus may not be enough to really grow the economy in the way that the markets had been pricing in the first excitement, that first week or two right afterwards. So unless you see a huge impulse from China on the growth side, I think you're going to be fine on oil. And in the end, if you go back to 1960, okay, and you look at all the geopolitical events, and then you look at the performance of the stock market 3 and 6 months later, unless there was a financial shock associated with it, like an oil price spike, markets recovered and were higher 3 and 6 months later. So the geopolitical risk is a talking point. But it should never affect your investing, because it doesn't work as an independent variable signifying what you're going to do or what's going to be afterwards. The one risk here, of course, is the oil market. That is what can affect the markets, and that's how geopolitical risk tends to get mediated into the markets, as the Russian invasion of Ukraine was in 2022 when we had $120 oil.
Crude, a little bit softer this morning. Alicia, good to see you.
Great to
as
see you
always.
guys.
Thank you. Alicia Levine of BNY Wealth there. Equity futures on the S&P down by 0.25% with an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Boeing reported its first quarter with CEO Kelly Ortberg at the helm. In it, Ortberg warned that Boeing will need to overhaul its culture to end its multi-year crisis. He laid out a four-pronged plan to move forward, saying it will, quote, take time to return Boeing to its former legacy. As for the earnings themselves, Boeing reported a negative free cash flow of $2 billion in the quarter. JP Morgan is in talks to start trading physical LNG after more than a decade on the sidelines. People familiar told us that the bank has held talks to secure a long-term LNG supply, and at least 3 projects are under development in the Gulf Coast. JPM has been pushing in recent years to get back into trading some of those physical commodities that it abandoned in 2014. Security State Anthony Blinken has arrived in Saudi Arabia after meeting with Israeli Prime Minister Benjamin Netanyahu and President Isaac Herzog in Israel. Blinken said both agreed that the killing of Hamas leader Yahya Sinwar has opened new possibilities for ending the war in Gaza, but made no indication on a plan for what comes next. This is Blinken's 11th trip to the Middle East since last year's attacks on October 7th, and likely his last before the presidential election. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the Morning Calls Plus, Republican Senator Thom Tillis of North Carolina. That conversation just around the corner. From New York, good morning. The opening bow 1 hour and 14 minutes away. Equity futures on the S&P 500 negative here by 0.25%. Treasuries softer, lower down for a third consecutive session. Yields a little bit higher. We're up by almost 3 basis points. Your 10-year 423.36. Time now for some morning calls. First up, Baird downgrading McDonald's to neutral, saying reports of an E. coli outbreak could impact consumer sentiment. You think? We're down by 7% in the pre-market. Your second call from Stifel kind of gets price target on Starbucks to 105, pointing to weaker than expected top-line results. We're down there by 3.3. And finally, JMP Securities upgrading Snap to outperform. The analyst expecting a strong earnings report next week. The stock is up by 2.5%. Let's turn to the election. More than 1 million people have cast early votes in the key swing state of North Carolina as communities there continue to grapple with the aftermath of Hurricane Helene. Polling averages in the state showing Trump holding a lead under 0.5 percentage point. I'm pleased to say that joining us now is the North Carolina Senator, Thom Tillis. Senator Tillis, it's good to see you, sir. Thanks for being here. Let's start with your community. Good morning to you. What a difficult moment for North Carolina. Can you just walk us through the devastation that you've witnessed over the last month?
Yeah, I think it's important for everyone to understand. We've seen the images of Asheville, and it's a profound problem there, but it's an impact zone roughly the size of the state of Massachusetts. So what you've seen in Asheville, I can take you to a dozen other places where people are suffering, communities cut off. No drinkable water in Asheville yet, and it may take a few more weeks before they can start boiling water. So it's a crisis that we've never seen in the mountains. We have never in this country seen a hurricane impact in the mountains. It basically maintained the integrity of a hurricane, went up into North Carolina, dumped 30 inches of water on several river basins simultaneously. And so we've got a long haul. We've got a 20-mile segment of I-40 that's going to be shut down for a year or two. $1 billion for that one piece of infrastructure, 80 miles of railroad bed, hundreds of bridges and roads. So we've got a lot of work cut out for us. And one of the things we're going to have to do is recognize that this recovery is very different from any other storm. It's going to take longer. We're going to have exceptions that generally only last for a year or two, for probably 4 or 5 years to get rebuilt.
Are you getting everything you deserve and you need from the federal government?
I think at this point we're doing okay. I had some differences with the governor about surging DOD resources from Fort Bragg, Fort Liberty, and the 101st Airborne. A little slow to respond, but I think that they're doing a good job. And the relief effort on the ground, FEMA resources, American Red Cross, Samaritan's Purse, all of those folks are doing extraordinary work, as they always do in a storm impact.
the vast majorities of the counties that were hit voted Republican in 2020. What is it looking like now, getting these individuals to the polls?
Well, actually, they're doing an extraordinary job. Yancey County, which was one of the hardest hit areas, had amazing turnout. And one of the things we're working with here is we're doing early voting very differently. Normally, North Carolina is one of the first states to vote, and that's in September for early voting. Where we got delayed for a variety of reasons, one of which was updating the ballot. But they're coming out. We've just got to make sure that they have that opportunity. The legislature has passed laws 2 weeks ago that allow them to vote in various locations, so they're not as stringent if you're in a disaster-declared county. So we're doing everything to make sure that every vote counts.
So do you think the hurricane is going to have an impact on potentially Donald Trump being able to maintain his hold on North Carolina being a red state?
No, I don't think so. I think President Trump wins by a margin of about what he won in 2020. I was up for election in the same year. I think that President Trump carries the state.
Meanwhile, you've been vocal about how you see things back in D.C., especially as we head to November, sort of hard pivot. I apologize, but I am curious to get your take on it, because not only in November are we going to get a presidential election, but we're also going to get Senate Minority Leader Mitch McConnell stepping down. Are you in the running? Are you going to be the Senate?
I'm going to vote for a guy named John, and with all due respect. But I'm going to vote.
We need a last name to understand what you're talking about.
Yeah, thanks.
I don't think they want it to be Pharaoh. Yeah. But carry on, please.
They're both solid leaders. They're both good friends of mine, and I think they'll do a good job of leading the conference. We're going to have that vote in a couple of weeks.
There's been a lot of pushback saying we need new leadership. We need a different brand of leadership. That's sort of the old guard of Republican rule or governance in Washington, D.C. And it seems like the Donald Trump camp has been at loggerheads in the past with that particular leadership group. Do you think that his coming back to the presidential office would challenge either of those Johns, John Thune or John Cornyn, if people were wondering?
I forgot. I don't think so. The Senate is a weird thing to understand unless you're a part of it. We like to be led by people who have an election certificate who are senators. So we tend to elect our leaders from within. We don't like outside influences. The arguments that were set forth by one of my colleagues, Mike Lee, are arguments that we have to distinguish between the Senate rules and the conference rules. What Mike or Senator Lee is talking about doing is the conference rules, which would unilaterally weaken our leader as they match up to the Democrat leader. If we want to have a discussion about changing some of the Senate rules, count me in. I've got a long list, but that's going to require bipartisan agreement to make the Senate more efficient. It makes no sense to unilaterally disarm against a very powerful leader model in the Democrat conference.
Or do you think then that either of these senators named John are just basically going to be a continuation of Mitch McConnell and his style and his leadership?
No, I don't think so. I think the other thing that's funny about Mitch McConnell, incidentally, I have a dog named Mitch. I'm a big fan of Mitch McConnell.
Was it actually named after Mitch?
It was named after Mitch. He's about 4 years old, and he's an extraordinary dog. Mitch is an extraordinary leader. But people get it wrong. You don't go into the office and get assigned a legislative initiative by Mitch McConnell. You go get a good idea, sell the leadership on it, and run with it. And so I would just argue for people who think that that's how it works to open their eyes and realize if you step up and you lead and you have something that you can build support for in the conference, you're going to be able to move it. That's just the way that Mitch operates.
You're talking about the way that Senate operates, and that is traditionally. And we're dealing with an election right now where there have been some questions about whether some of those rules would be questioned or undermined, not necessarily with the Senate, but certainly with federal employees and what we've heard, some of the proposals from former President Donald Trump. And I'm just wondering whether you think that his style clashes with the style that you are talking about and that you've been a part of.
No, actually, President Trump's style is what we need. I was a management consultant. I was a partner at Pricewaterhouse, did organization transformation. You need people that stretch, right? And President Trump set stretch goals. But you need that kind of friction between the two branches of government, I think, to really get moving more quickly, to get things done, not just to continue to promise every 4 years that this is the 4 years it's going to get done. So as long as we've got to exercise patience with the executive branch has to exercise patience with us, because we need to get legislation out the door that has enduring quality. And the only way you do that is through bipartisan results. We are clearly, if we run the table, going to use reconciliation, simple majorities, no Democrat votes, to extend the tax provisions from 2017, et cetera. But we should never take our eye off the ball of working with Democrats, as I have multiple times, on significant legislation to actually do the hard work in the Senate.
Well, you're from a purple state. You're governor right now. I interviewed a few weeks ago, Roy Cooper. You have to work with him a lot. But I want to ask you about leading North Carolina. What do you make of your Republican candidate for the governorship?
Well, Mr. Robinson and I have a disagreement. Mine was more rooted in I think, the credentials for the job. We are the 9th most populous state, and we're one of the most popular states to move to for business. We have to have proven executive leadership there. I serve with Josh Stein. I believe he is a pro-tax, pro-regulation liberal. And I wish we were matching up a candidate that could actually defeat him. I just don't think that Mr. Robinson's going to get it done.
Final question. Madison Square Garden, Donald Trump campaign. You attending?
I am not going to.
Just wondering if that's why you're in town.
I will be back in North Carolina.
Senator, appreciate your time and good luck with the rebuild. Thinking of you all. Thank you, sir. Senator Thom Tillis there of North Carolina. Coming up next on this programme, we'll catch up with Francis Donald of RBC and Troy Gayeski of FS Investments. Your equity market shaping up as follows this morning. On the S&P, we're a bit softer near session lows. We're down 0.2%. Bond yields drifting higher once again, up by 3 basis points on a 10-year right now, 4.23, call it 4.24 almost. And in foreign exchange, stands out for me this morning, session highs. Dollar yen takes out 153. Takes out 153, and bear in mind, the low of the year was 2 days before the Federal Reserve cut interest rates on September 16th. That was the low at 140. That's a monster turnaround in dollar yen. 153, we're up by 1.3%. From New York City, this is Bloomberg. One hour away from the opening bell. Equity futures just off session lows. We're down just a touch once again. We're negative by 0.25%. With 60 minutes until the cash open, let's get you some morning movers and cross over to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. McDonald's is off its low point of the day. It's grappling with the E. coli breakout, where you have dozens of illnesses and 1 death. The question here is about containment, control, and convincing the investor out there that they have got a handle on this. JP Morgan say the stock is now trading on emotion and worry, and that this E. coli breakout is not going to engulf the United States of America nor go international. You want to buy the sell-off, according to JPM. Morgan Stanley say it's a knee-jerk reaction. There are 2 big houses on the street, however, that caution and downgrade their price targets. Bird goes to 290 on a downgrade, and you've got Guggenheim cautious on this stock at 285. So again, it depends on whether you believe containment and control has been delivered. Revenge tourism, it was a narrative of 22, 23, and is it fading in 2024? Hilton lowers their profit outlook. Is revenge tourism fading? That's the question that goes through my mind. You look at the RevPAR here in the United States of America, revenue per available room, it grows by 1%. In Europe, it's up nearly 7%, but here there is just a little bit of a leveling off. You've got strikes, of course, that they've worked their way through, and you have Hurricane Helene. This is as they add 33,000 new rooms. It's a record for Hilton, expanding into a slowdown. Let me take you to Qualcomm. This is the kind of nuclear option that ARM has gone for. They scrapped the design license with Qualcomm. 60 days and counting to get a deal on this dispute. It impacts both of them. So it looks like ARM's gone for the nuclear option. JP Morgan say that they will probably negotiate a deal. But some context for you. Qualcomm sell about 100 million processors into phones, Android phones, along with PCs. And do not underestimate, Qualcomm is 11% of ARM's revenue. This is a battle that will brew for 60 days. Jonathan, good morning.
Manus Cranny, good morning to you, sir. Appreciate it. I haven't heard that phrase for a long time. Revenge tourism, revenge spend. I remember Chris Harvey of Wells Fargo came out just after the pandemic, lockdown's over, and he said, John, it's going to be spring break for adults for the next 2 years. And that's what it was.
It was, and then it was get back to the office, spring break is over.
Yeah.
And we've seen that increasingly. What did you say earlier? That you invest in the U.S. and you travel and you tour in Europe?
It's not my line. I've heard this a few times. Yeah.
So that's essentially what he explained.
Europe's good for vacations,
yeah, exactly.
but not for investing in.
Thank you. Yeah, that's good.
Yeah, that's the line.
Thanks.
Not my line. I'm not going to name the guy who said it because I found it offensive at the time. I was upset with him. Investors are waiting fresh economic data this week, looking for further signs of economic strength. Francis Donald of RBC writing, forget soft landing versus hard landing. The US is in a K-shaped economy. Certain segments of the US economy are doing exceptionally well, but others are empirically recessionary. Francis joins us now and got a round of applause when she walked into the studio. Congratulations on the new seat. It's good to see you.
Thank you. It's very exciting.
It's good to catch up with you. Let's talk about this economy. How do you set policy for that economy?
Oh, well, you have to set policy for the aggregate. And that's why when you have folks coming on this show, they're talking about the whole size of the pie. And when you look at the economy as a whole, it is in what they would call a soft landing. It is going to be really difficult in 2025 to get 2 quarters of negative GDP. And yet, if you're doing anything else in this economy, if you're a small business owner, if you're picking stocks, you have to go beyond that GDP number. You have to look under the surface. And when you do that, what you will find is that it is not just a dual mandate for the Federal Reserve, it is a dual economy. We have pockets of extraordinary strength and resilience, big companies, high-income consumers, and then we have pockets of real weakness, small businesses, low income. So when folks say, you know, there are recessionary signals, they are right. When they say the economy is resilient, they are also right. I'm like a mom at a football game. Everybody wins. Everybody is correct in this environment. It depends what your target is going to be.
Well, let's work with the aggregate for the focus for the purpose of policy. In August, we'd just come off the July jobs report. Not great. Chairman Powell goes to Jackson Hole, delivers a really dovish speech, and the conversation changes really quickly. There are major concerns about cracks in the labour market and maybe this horrible cycle where this unemployment rate just feeds on itself and we start to approach 5 pretty quickly. 2 months later, we've got guests debating whether this economy is reaccelerating.
What you're speaking to is extraordinary amounts of uncertainty. And I know we talk about all the time, but there is a extraordinary uncertainty tax on this economy. It is coming from the election. Huge amounts of surveys are telling us, businesses are saying we can't make decisions until we know the outcome. So there's a pause occurring on it. Revisions in the data. How often are we talking about massive revisions that change the story? Who knows? Maybe we could get a big revision over last month's data. And then, of course, we have very low response rates. So our ability to navigate month to month is certainly declining. That's why we have to focus on some of these longer 6 to 12 month themes. My sense is that the Federal Reserve is going to have to do this too, because they're aware of how limited their visibility is as well. What they should be looking at is that the unemployment rate has been steadily rising since January of 2023. The trend is going in that direction. They're going to be focusing on massive amounts of deficit and debt at the federal level, how that offsets or the risks that there has to be a pullback sometime in the next few years. And they're going to be focused on normalizing those rates to bring them back in line with where the general sense of the economy is. I hope this Federal Reserve is not going month to month off of the data when we're seeing this level of revisions, uncertainty, and low response rates.
You said something that I want to pick up on, the uncertainty tax that we're seeing sort of excised over this economy. If that's the case, then what's to say once that uncertainty tax is lifted, we'll know who ostensibly gets elected, and that has passed us, and some of these other levels of uncertainty also come down. Won't that just reignite some of the confidence in the C-suite, especially at companies that do have cash, that have been waiting on investments, that have been waiting on hiring plans?
Well, that'll depend on the outcome of the elections and the policies that are being put forth. But, you know, we also may be in a period of uncertainty between November and January as well. Certain political experts have spoken to that. So it's going to depend on that outcome. Meanwhile, behind the surface, small businesses, the least confident they have been since the great financial crisis. That's not a little thing. They have their highest uncertainty and their lowest confidence. Let's remember, small businesses employ 80% of Americans. So in the background, there are these 6 to 12 months trends that are gaining some steam. The Fed has to get in front of that in order to stick the soft landing. That's why we continue to think they'll be easing policy policy into Q1 of next year.
So you talk about a K-shaped recovery, a K-shaped economy. You talk about this with consumers, and you also talk about this with specific sectors. And I'm just wondering, we have seen the industrial sectors in a recession for quite a while. There is some thought that maybe they're emerging from it. And now there are questions about whether some of the consumer-facing service sectors are going to see some declines after really go-go days of the post-pandemic era. Is that kind of how you see things?
I'm so happy you bring up the industrial space, manufacturing, because as much as we're talking about the labor market, one of the most interesting facts for me in the U.S. economy is that industrial production is actually smaller now than it was in 2018. The U.S. manufacturing segment is going through one of these, what I call real pockets of weakness or almost recessionary environments. Of course, we're seeing that globally as well. We're going to have to see a pickup on that if we want that side of the economy to really start reaccelerating and supporting the consumer side. The consumer is going to come down to wages and employment. And what concerns me now is that employment momentum is not going in the right direction. We need something to arrest that. Hopefully that turns out to be Fed cuts and a little bit of certainty coming out of the election.
So where's all the industrial policy money from Washington, D.C. gone?
It's not in the data. That's the real thing that we're seeing now. So month to month, we're not seeing it in ISM data. We're certainly not seeing it in the aggregate pie. And economists like to say, oh, we're not political. We don't make political statements, and I'll hold to that. But it's been very interesting to me in this particular election that we see the econ data over the past 5 to 6 years really coincident and on the same sort of themes as we see the political discourse.
Do you think that with either one of these candidates, potentially you would see a pickup in the manufacturing base in the United States? Potentially one that's talking about tariffs going around the entire wall of the U.S.?
Yeah, it'll depend on what the composition of the outlook looks like. But meanwhile, the U.S. actually has a very small share of its economy on manufacturing. Not so true for the rest of the world. Places like Germany, of course, no K-shaped recovery there. We can use hard landing for places like Germany. And just to kind of rhyme on that K-shaped theme, it's not just the U.S. economy that's in a K-shape. It's the global economy that's in a K-shape. And that upper lever, the winner, is by far the U.S. economy because it is more consumer levered, because it has less of that manufacturing exposure.
You mentioned something, and I'm not going to let this go.
Okay.
This idea that you see people's political views as economists sort of borne out by some of their expectations, their economic expectations. Are there economic expectations and projections right now that are coming out from either bent that seem overplayed to you or gaining a lot of popularity that might not be as rooted in economic theory?
Well, here's what I see. I turn on the TV, I watch Bloomberg every day, and I hear the economy is resilient, GDP's just fine, the unemployment rate is really low. But if you're a low-income consumer in the U.S., and the Federal Reserve just published data showing this, your spending is about half the growth that the high-income consumer has seen. You are not seeing the same real wage growth. So there's a disconnect between that aggregate conversation and what many individual experiences are feeling. And problematically, the top 20% of Americans fuel 40% of growth. So it's no surprise to me that we see perhaps a sentiment disconnect or a confusion over how come the experts who talk about GDP and non-farm payrolls don't reflect my everyday experience. That only takes an extra 10 minutes in the data to see that big divide between it. And I think it's something we maybe need to pay attention to in this particular cycle.
I think that speaks perfectly to the disconnect that we've seen over the last 3.5 years between some of the messaging we've seen out of the administration and what many people actually just feel on the ground. And many times they felt like they were being gaslit by the administration.
Right.
Bidenomics. And they were sitting at home thinking, I don't feel that at all.
Sitting at home, going to the grocery store, realizing they're paying a lot more and their wages haven't kept up and those prices have not to come down. Maybe it's on the economic data, but what you're talking about, Francis, I see all the time in the polling data, especially when individuals have a chance to write in how they're feeling about certain sectors of the economy or a particular administration. They are not feeling what this good data is showing across the Bloomberg terminal screens.
Or take inflation as an example. So here we are saying, hurrah, inflation has come down, but prices are still over 20% higher than they were before COVID. Most folks in their day-to-day life are not saying, oh, this cauliflower I bought today was this amount exactly 12 months ago. They're looking at what things cost. So, it's not that the econ data is wrong. And as you started with, John, the Federal Reserve has to set policy based on the aggregate. Our stock market is driven by the aggregate. So it's not wrong to talk about that. But if you just go a layer deeply, you'll or more deeply, you'll see why there seems to be a disconnect in the data and why some data points, like for example, small business confidence, seem completely disconnected from standard models.
This was a clinic. We've missed you, and it's good to have you back.
It's great to be back.
Thanks for being back. Francis Donald there of RBC. Your equity market on the S&P 500, a little bit softer here. We're down by a third of 1%, rolling over just a little bit. If you check out the bond market board, yields grinding higher even more, taking out 424 on a 10-year. Joining us now is Troy Gayeski of FS Investments. Troy, what is this bond doing at 424?
Well, I mean, what we've had happen here, clearly, as we articulated over the last 1 to 6 months, is, when the Fed goes to cut, as we expected them to towards the end of the year, and the economy comfortably avoids recession, you're going to have a twist of the yield curve. And, historically, the spread between 10-year and Fed funds has been somewhere between 125 and 150 basis points over a full cycle. And there have been times where it's been 200 to 300 basis points or higher. So, we always question that thesis from the bond permeables of like, hey, the Fed's going to cut and the back end's going to drop. That just never made any sense to us. And if anything, we should have a steeper yield curve now because we're obviously in a higher for longer inflationary environment. We're going to issue over 20 trillion treasuries. Treasuries have over the next 10 years, treasuries have the worst stock to flow by far of any major asset class. 20 trillion is 72% plus of the existing stock out there. And so I think anyone that jumped on the bond duration train is having regrets right now.
They might be having regrets right now, but on the flip side, we don't really see what's on the other side of this. And we have a number of people, including Matt Hornbach, saying that maybe people are overreacting or expecting an overreaction to any potential election outcome, and that ostensibly we are going to see that disinflation continue. Troy, at what point do 10-year yields become attractive to you, understanding what you just said in terms of just bonds losing some of that ballast type reputation?
Yeah, so when you look forward, I mean, we've probably bottomed for inflation for the time being. We expect a modest reacceleration next year, nothing like 21 or 22, but, think core in the high 2s, low 3s, somewhere in that range. And so from our perspective, you take the front end of 3. The soonest we could see that happen is the summer of next year. The latest is the end of 26. That means roughly around, high 4s, 5%. Which is sort of where we were in October of last year when we were having the issuance panic and we had that big gap up in yields. Then you're starting to get to a point where, because of the roll down the yield curve and the additional yield, you have attractive yield, you have hedge protection, and you have roll down the yield curve. But for the time being, it's really difficult to get overly excited about duration, especially when there's so many other alternatives like private credit, for instance, or senior commercial real estate lending.
You say other alternatives, and then you go to, private credit and other types of alternative lending. Are you saying that stocks also have similar kinds of hair on them in terms of just a valuation issue?
Well, yeah. So when you look at equities, we're going to get growth, right? The U.S. economy, your last guest was dynamite describing the K-shaped progression of it. Obviously, lower-end consumers have been struggling for quite some time, have been hit hard by inflation, shows up in all the polling data. Upper-end consumers in great shape, again, shows up in the polling data, much more supportive of the current administration. But if you think about equities, the problem is not growth. The problem is valuation, right? You're 22 times forward earnings. Whenever you have a 20 multiple or higher, and by the way, we're very sympathetic to the fact that we should have a sustained higher multiple, just given the concentration of markets and the incredible free cash flow margins of mega cap tech. But nonetheless, you tend to have much more muted forward returns. And clearly, there's been a little overextension in the short term. So in the event that yields keep going higher, we could have a mini repeat of what we saw multiple times the last 2 years, where higher yields are driving multiple compression. And then locally, Lisa, the only fundamental problem we see with valuations going into next year, not tied to long-term performance, but near-term, is, nominal GDP has slowed and we expect we should continue to slow. Yet markets are pricing in revenue acceleration for the S&P and also approximately a 10% margin expansion. We can get there if the market becomes narrower and narrower. I think mega cap tech, Magnificent Seven minus Tesla plus Eli Lilly, Salesforce going to 40 or 45% of the S&P. But that just seems unlikely to us, given how much broader this rally has become. So, those are curious data points, like 10% acceleration operating margin, reacceleration of revenue. That's a really high hurdle to meet. So, forward returns are just going to be much more muted. And volatility is not going to be as high as it was in 22, but it should be higher than it's been, since October of 22 through today.
Troy, good to hear from you, sir. As always, it's good to see you. Troy Gayeski there of FS Investments. We started that conversation on the bond market. I'm so pleased that Troy went there. I think this is important. We've had a move of 40, 50 basis points on a 10-year yield since the Federal Reserve reduced interest rates by 50 basis points back on September 18th. Troy's point that lower rates are leading to higher yields, I think, is a really important one.
The idea that because the Fed is easing, or adjusting policy, they are allowing growth to be more robust over a longer term and actually allowing, theoretically, inflation to be a little bit higher over the long term, which is something that you are seeing in the break-even rates. And perhaps that's what's being reflected in yields.
424 on a 10-year. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Frontier Airlines is exploring a renewed bid for Spirit. The Wall Street Journal reporting that the budget airlines have had recent discussions about a possible merger. People familiar said the talks, though, are at an early stage. If a deal between the two carriers is reached, it would happen likely as part of Spirit restructuring its debt and liabilities in bankruptcy, according to those people familiar. Starbucks has pulled its guidance for 2025. The coffee chain reporting its steepest quarterly sales drop in 4 years, with weakness especially evident in both the U.S. and China. Starbucks says withdrawing guidance for the current fiscal year will give new CEO Brian Niccol an opportunity to solidify a turnaround plan. Microsoft co-founder Bill Gates is throwing his support behind Vice President Kamala Harris. The New York Times reporting that Gates said privately that he recently donated about $50 million to back Harris. Gates made his donation to Future Forward, the main outside fundraising group supporting Harris. In a statement to the Times, Gates said this election is different. That's your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. You're watching Bloomberg TV. The open about 38 minutes away. Equity futures down by 1/3% on the S&P 500. Check this out in the bond market. Yields up again, up by 3 basis points. It's just persistent. Keeps going. 424 on a US 10-year. Let's get to the trading diary, the calendar. Stacking up as follows. The Fed beige book at 2 p.m. Eastern Time. Lisa logged into the Bloomberg,
well, 100%.
waiting for it to drop. I know.
Yeah, I mean, I'll be on a train to Washington, D.C.
Tesla reporting earnings after the closing bell. Tomorrow, another round of jobless claims plus S&P Global PMIs. Plus, we'll also get earnings from UPS, Southwest and American Airlines on Friday. Durable goods and UMich consumer sentiment. Over in Sao Paulo, Brazil, the Bloomberg New Economy Forum continues today. Joining us now is Bloomberg's Jemana Versace. Jemana, congratulations for getting this one, because this is the one we all wanted to be at. Just a phenomenal conference. Walk us through what's coming up.
Hi, guys. Good to see you. A bit out of context. That's right. Well, it's all kicking off in Brazil. There are plenty of events happening here. B20 kicks off tomorrow. There's G20 in a month's time. And then next year, of course, Rio de Janeiro is hosting COP. But for now, we're here at the Bloomberg New Economy Forum. The title of today's forum is Bracing for a New Reality. And of course, the world has to adapt to so many different pressures now, from climate change to geopolitical risks, war, conflict, in addition to advances in technology. But this is really an opportunity to bring together some of the leading voices, policymakers, industry leaders, to discuss some of these challenges. And top of mind, of course, is the growth outlook. Yesterday, you may have noticed that out of all of the advanced economies and developing economies in the world, Brazil was one of the few that actually got upgraded with their growth profile for next year, an increase of 0.9%. But does that change in a world of protectionism, potential new tariffs coming out of the U.S., a lot of talk about the upcoming presidential elections? You also will recall that President Trump was very close to the former Brazilian President Bolsonaro, who is the current rival of President Lula. So that is one factor to take into consideration. How will relations change should there be a change in the White House administration? Also going to be talking about the digital disruption that's taking place. I have a panel on this later with the Google president of Brazil. And again, here you may also remember that the Brazilian regulator had a bit of a run-in recently with Elon Musk over this social media platform, over concerns that it was being used to spread disinformation. So again, one of the questions we're going to be posing is, how do you get that balance right between regulation and innovation? And then last but not least, of course, we're going to be talking about the push towards low carbon. We are in Brazil, home to the Amazon. It is considered to be the lungs of the earth. But at the same time, and this is a statistic that I didn't know before I came here, 93% of the electricity generated in Brazil is generated from renewable sources of energy. So how do you take that template and how do you make it at scale? And how do you mobilize the sufficient amount of capital into these types of technologies so that we can move towards a more cleaner and greener energy transition in the future? Those are going to be some of the questions posed here.
Jemima, thank you. Thank you very much. I'm not jealous at all.
Oh, yeah.
I know where I'd rather be this morning.
Honestly.
I love you guys.
Okay,
but
yeah,
I love that city a little bit more.
Yeah, not just the city, but also that particular hotel.
Yeah.
Very
it's
beautiful.
One of the best in the world.
It's pretty amazing.
It's just
I've never been. I've never had the opportunity.
phenomenal.
I wasn't invited.
This is where Bramo's going. Coming up tomorrow on Friday. Here's Lisa's lineup. In Washington for the IMF and World Bank meetings, speaking with the South Africa Reserve Bank Governor, Lesetja Kganyago, the Bundesbank President, Joachim Nagel, John Lipsky, the former IMF First Deputy Managing Director, and the City Chairman, John Dugan. Have you got a favourite? What are you looking forward to?
Oof, that's like picking a favourite child. I'm not saying their child. No. But honestly, I think it's going to be really interesting to get both of you from policymakers and central bankers, as well as some of the big executives from banking industry. So we're not only going to have John Dugan, we're also actually going to have an interview with Christian Saving. We're also going to have an interview with Sergio Armati and Botín, a number of different executives, particularly in the European banking sector. Curious to see how the ties go together at a time where there are a lot of economic questions on both sides.
So no favourites, but the bank CEOs, apparently. Coming up tomorrow, Dan Ives of Wedbush, Deputy National Security Advisor Daleep Singh. You actually are, literally. Former House Speaker Kevin McCarthy and Biggie Chadha at Deutsche Bank. Stack lineup tomorrow. Tune in from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.